We've seen strong earnings across most sectors, and we've seen the markets perform well across most sectors.
There is no lack of desire and demand in these markets, even when you're getting balance sheets that maybe aren't that strong.
When you think about the performance recently, really strong first half.
This market is just beholden by tech and AI and everything related.
The operative word remains resilient.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, facing a narrative shift. Meta shaking up the AI trade, pushing global chip stocks lower as Apple is lobbying Washington to let it buy Chinese-made memory. OpenAI is reportedly proposing giving up a 5% stake to the government. The tech trade facing some headwinds.
The bottom line behind all of the headwinds has been costs matter. Who's going to pay for it? Ultimately, at what point are the costs, particularly for some of the chips names, becoming punitive for some of these hyperscalers to really justify it? And initially, hyperscalers were beaten up. Now we're seeing hyperscalers take action. Meta trying to become a hyperscaler because that's better than just sort of spending money into the ether. Either way, suddenly people are looking at the ball of cash and saying, how does this equation square? And suddenly investors are really trying to be discerning on that.
Fantastic reporting from the team here at Bloomberg, so congratulations to them on that with regards to Meta. In the Bloomberg reporting, there was a really important word. Just one word. Excess. It's a word I haven't seen in a while because we've been told repeatedly that we are constrained. And then you see this word, excess. Not constrained, not bottlenecks, but excess. Does that upend the AI thesis?
There are two ways to read this. On one hand, you could say, well, suddenly Meta bought more compute than they knew what to do with, and so they would like to be more profitable, and what their own proprietary systems are doing isn't worth what they could sell that compute for, right? So that's number one. Number two is a real question about efficiency, a question about competition, and a question about just whether other people can do it better and if Meta understands that. Either way, there is a feeling right now that there is a rationalization. How do you justify more than $100 billion in spending this year? And ultimately for Meta, they've got to find a pay for it. Interesting, their shares climbed dramatically. All of the neoclouds, not so much because of exactly the thesis that you're raising.
For Meta, it's a new revenue stream. It's a new business they can open up. But you're right, Jonathan, that word about excessive. Basically, Meta is saying that they potentially overspent, and now they have all this extra supply that they can now sell to the market.
There's a 1-2 punch as well for chip stocks. It's not just this story with regards to Meta, it's also Apple. We've seen some reporting with regards to this, looking to China and actively lobbying the government to allow them to buy Chinese-made memory. Does that open the door to a little bit more of a bearish thesis for some of these names?
This is the reason why South Korea is investing so much in expanding their memory chip production, because they can't keep up. And SK Hynix and Samsung don't want to cede control over to the Chinese manufacturers. What's going to happen if they can't ramp up production faster? They're going to cede control to some of the Chinese manufacturers of memory. And Apple, after just having raised prices, is saying, look, we got to do something to bring down prices. We only have 3 memory chip suppliers that we rely on. Let's make it 5.
Forget the supply and demand dynamics. This is going to be a headache in Washington, D.C., because the two companies China is looking at to potentially buy these chips are on a blacklist when it comes to the DoD because of concern that they aid the Chinese military. So you have Tim Cook trying to lobby Secretary Bessent, Secretary Lutnick to even allow this to potentially be an idea. The one thing that maybe will give it the green light, these chip components will only be used in iPhones sold in China, not in the United States.
That's a really good point. Apple this morning in the pre-market, just about firmer by 0.4%. So far this morning, equity futures pulling back just a touch as well. There's an additional story we need to talk about, and it's OpenAI. Looking to give up a 5% stake. I think language really matters here. It's not the government taking stakes. It's the company looking to give up a 5% stake. Question is why?
Well, to get favor from the government, and clearly there is a path that really represents this. There's a precedent for this. It's in Intel. The president was really upset with Intel's CEO and jawboned them and talked terribly about them. And then suddenly the U.S. government took a stake in Intel. And now he has only wonderful things to say about Intel. And that gives you a sense of the potential currency of giving up 5% stake. There's a huge asterisk here. It wouldn't just be OpenAI. They're proposing that all of the tech companies give a 5% stake to some sort of domestic sovereign wealth fund. That's going to be a harder sell.
Is this about sharing the gains or sharing the potential burden down the road for a company that people are asking a lot of questions about?
I think likely they're going to try to sell, and Sam Altman did that yesterday in a Financial Times opinion piece, that this is about the gains, this is about making sure that if they are building these AI models off of all the growth in society, whether it's reporting, culture, et cetera, that everyone, also if you look at opinion polls, they also feel that maybe they should get some upside in this. But this is making sure that they get better regulatory approval. This is making sure that they get green lights. And of course, if the AI trade is potentially a bubble, they are sharing in the downside.
Tyler Kendall down in Washington, she's going to join us in about 10 minutes' time on this story. Equity futures on a back foot on the Nasdaq, on the S&P down by, let's call it 0.2%. Coming up this hour, we'll catch up with Peter Tchir of Academy with chip stocks leading Wall Street lower. Stefan Slowinski of BNP Paribas as Meta's AI cloud bet weighs on CoreWeave and Nebius, and Marc Giannoni of Barclays as investors await a fresh read on the labour market. For that matter, it is Payrolls Thursday. We begin this hour with stocks sliding as the tech rout deepens. Peter Tchir of Academy writing, is the cost of using AI rising even faster than the benefits? The growing angst is something companies need to aggressively address before it becomes a problem. Pete joins us now for more. Pete, good morning.
Morning.
You wrote that coming into this month, and already this month things are shifting pretty quickly. I've got to ask the question, if we're capacity constrained, why does SpaceX, why does Meta have excess capacity?
It is strange here. You just went through 3 headlines, all of which certainly could have negative connotations for this industry. I don't think we've had a day like that, right? There's clearly positive interpretations of all of these, but I think it does bring that question. Have we overbuilt? It reminds me again, we talked about this a couple of years ago, and we haven't had a strong opinion on it, but the fiber industry, right? Fiber built out everywhere. Then we had excess fiber for a number of years. So, is this every small little agentic AI startup needing and willing to pay for compute so they can IPO? It's hard to tell, but this feels like some of this kind of circular narratives starting to break apart.
So one big trade that developed more recently over the last few months was to get long the capex takers and get short some of the hyperscalers. Is the trade about to flip?
I feel maybe everything kind of slides for a little bit, right? Everything's kind of been pretty highly valued. We've been building out. We've had this kind of almost 2-tier economy, right? The AI build out, everything associated with the AI build out, and everything else. And the everything else is doing okay. The AI build out's been driving things. Maybe people start to question that. Again, there's been all sorts of debt issuance. People are, it's come to the market, it's come well, people want it. But are we hitting that point where people say, let's see how this actually plays out? Again, I think everyone right now, when I go to conferences, we talk to people, no one wants to hear about AI generically. They want to hear, what's your use case? What have you done with it? What have you been successful with it? They want case studies. And it tells me, I think we're all going through this sort of process where here we're using it, here we're now getting our bill for our tokens. Did I get enough value for that tokens? And that's a very different conversation than this time last year, where everything was kind of free, right? You could play around with it, it was very cheap. I think this is kind of where the rubber hits the road, and the rubber meets the road. And are we getting enough, and do we see a slowdown in AI spending?
Are you surprised that equity investors are pushing back more than debt investors?
Not really. I think these companies have such large market caps, such potential, that credit's so well protected. And again, credit's looking for, we've been so dull in credit. I used to talk about this all the time, right? The CDX indices, the Bloomberg, corporate OAS spread, it barely moves anymore. So I think anything that gives excess potential returns is, taken in. People want that. And I do think what we're seeing is people across the globe prefer U.S. corporate credit to U.S. government debt. So I think U.S. government debt's become very generic. Corporate credit with the extra spreads, that's interesting, and it's the only place to get that is U.S. for tech.
Just to be contrarian, if I'm hearing you talk, I would say, well, that means that the thesis is still intact. It's just sort of a question around volatility in a summer after a lot of gains and pulling back just a little bit as people get nervous, which is a positive thing, frankly, and it should make you actually more excited. Why doesn't it make you more excited to think that there is some discernment? These are 3 separate stories, all talking about pressuring prices lower as demand continues to increase by pretty much all accounts.
Well, I think everyone's been very nervous about the valuation side, and I think, the Kospi shows this again. There's so many structured products out there linked to these names that when buying begets buying, and unfortunately selling begets selling, right? We have so many leverage ETFs, the triple SOX leverage ETF, right? When those go up, they put extra pressure, and no one wants to talk about that. Everyone, it's my decision to buy these. There's a lot of pressure coming from zero-dated expiration options, all these leverage ETFs, and unfortunately it works in reverse, right? The last 2 days, we haven't seen yet today how it'll play out, but we seemed up ridiculously well on the month-end close, and yesterday seemed particularly weak on nothing. So I feel like the market structure is very weak. There's not the depth of liquidity people need. And if you really start seeing hedge funds or faster money say, hey, this trade's over, I think there's more selling pressure because that liquidity is not true and it hits these other products.
But in the short term, is this a buying opportunity?
I want to wait a little bit. I want to see where this plays out. Again, these valuations have gone phenomenally high, and maybe you want to start looking at who are some of the companies that, have maybe been blamed for spending too much and might pull back, and maybe you see that stock price come back, right? Again, we used to talk about the debt diet, where companies kind of got restricted and they did something to take care of their debt. We're not seeing that yet, but maybe you start seeing a different narrative, right? This is the first time you kind of wake up in the morning like, we need to spend, and the only problem we could have is not building enough compute. That doesn't necessarily sound like that's today's problem.
Elisa mentioned it. The big signal, the instructive signal coming from the market, Meta rallied, had a really nice day. And you wonder if the C-suite over at, say, Microsoft pays attention and says, you know what, I'll have some of that. The issue is, and you alluded to it, it's not just a market story. We've got an economic story as well. The market story increasingly becoming one trade and the economy increasingly firing on one engine. If they start pulling back on spending, do we have a macro risk starting to build here?
I think so. I think that would certainly hurt the economy. It would hurt the growth that we have. And the flip side of this, and I'll talk maybe a little bit about the OpenAI story, where they're talking about one of the risks that we've said is that the AI industry has not done a really good job, I think, in community outreach, right? They haven't done a good job convincing people, A, it's important for national security, B, it's good for your community if we build a data center or AI near you. I think they have to get back on track, and some of this is OpenAI. And you start looking, I think it was Utah, one of the people who lost recent by-election, blamed that their support for the data center cost them that. So I think this is becoming a political issue, and I could see things where you start seeing politicians run on, well, we're going to tax the AI, we're going to tax this. I don't know how they would do it, but it doesn't really matter, right? I think that momentum's building, and far faster than I would have expected. I would have expected that to be a 2028 issue. It feels like some politicians are going to be savvy and catch this mood, and I think the AI industry has to get out in front of it better than they've done. It's really got to be like the energy industry, other things, community outreach, explaining their story better.
You would need a genius PR firm to convince me that a data center next door would be good for me.
Well, they haven't helped their cause.
I'm not sure who's capable of doing that.
Okay, but they haven't helped their cause coming out and saying we're going to eradicate all white-collar jobs. I mean, how do you put that genie back in the bottle?
I totally agree. Anthropic, with regards to that, have done a really lousy job. And I think it's polluted the water for everybody else.
How do you then say, just kidding, actually it'll be just fine? They are trying to change their tone, but maybe the only way to get that genie back in the bottle is to say, here's money, here's a stake in us, and we'll give you all the payouts if we're successful.
That's the major difference between this story and Intel. Intel got paid for that stake. This is different.
This is different. And also, this is even before these companies go public. This is concepts of a plan, as the president would like to say. But when it comes to pushback from Americans, if you look at recent research and polling, Pew Research says that most Americans, or more Americans, think this has a negative effect on society, AI, than a positive effect. So already you're starting from that standpoint. You've got to convince the American people, let alone politicians in Washington, that this is a good idea.
Pete, we're going to come back to this story in just a moment. Peter Tchir of Academy is going to be sticking with us. If you're just tuning in, welcome to the programme. It is Payrolls Thursday. We've hardly talked about it. We're looking ahead to payrolls and looking for a little bit of a deceleration on the jobs number later.
We haven't talked about it because it's been all over the place. People haven't gotten it right. Sometimes it's up, sometimes it's down, and then it oscillates tremendously from month to month. I just wonder whether it has less importance than, say, the unemployment rate and wages. And right now, if that itself is just de-emphasized, because right now the Fed's focused on inflation, maybe, and the reaction function is who knows. And so people are just saying, you know what, we'll keep an eye on it, make sure it's not disruptive, and then go on vacation.
Bramo, he did acknowledge yesterday that we had started to see inflation expectations come in a bit.
He acknowledged market action.
That was new. Some newness to the comments from Fed Chair Walsh.
People viewed his market observation as being something new and forward guidance, which he said he wasn't giving, but sure.
The one thing I took away from that is, well, first off, he was very smooth, refused to talk about forward guidance, except for he said that when it was asked about the dot plot, he said, for now. It's here for now. We'll see where it goes in the future.
When we wrap up those big task force down in Washington, D.C., payrolls, 113, the estimate in our survey. We'll come back to that later. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. As you've been saying, the June U.S. payrolls report due out at 8:30 a.m. Eastern. The consensus estimate calling for an increase of 113,000 jobs. Bloomberg Economics forecasting a robust gain of 200,000, which would reinforce expectations for rate hikes this year. SAP is cutting back on hiring and travel to fund a, quote, significant AI push. In an email seen by Bloomberg, the company says it will mainly focus new hiring on core AI roles that are critical for its long-term success. Apple is in negotiations to purchase chips from two Chinese semiconductor companies that had been blacklisted by the Pentagon. Sources telling us here at Bloomberg the iPhone maker is lobbying the government to let it buy memory components for use in devices sold in China. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you as always. More from Vonnie in about 30 minutes' time. Up next on the programme, taking stakes in corporate America.
I said to Intel, give the United States of America 10% of your company. He said, you have a deal. He said it so fast, I said I should have asked for more. That stake is now worth $80 billion.
There's more to come. Bloomberg's Tyler Kendall joins us next. Payrolls later this morning, 8:30 Eastern Time. It is Payrolls Thursday. We're looking for 113 in our survey. That is the median estimate. That's down from 172 in the previous month. But you get something ballpark north of 100K. That keeps this labour market on track for some decent gains. Unemployment set to hold at 4.3%. As Lisa indicated a few times already, maybe the more important read will come from wages, against a backdrop of worries about above-target inflation at this Federal Reserve. Let's turn to the equity market. Equity futures this morning shaping up as follows. We're pulling back on the S&P by 1/10. We're down by 0.5 on the Nasdaq, falling short of a third day of gains on the S&P 500. The sector and single name price action far more interesting. Meta up 9%, almost 9% at the close yesterday as they look potentially to rent out excess capacity as they rallied. Chips, a setback, and for the neo-cloud providers, an even bigger setback. And there's questions this morning, still swirling. Are we upending the AI thesis?
If Meta has to justify why they're spending $125 to $145 billion this year, given the fact that their own AI initiatives haven't really borne fruit to the degree where they justify those expenses, it gives you a sense of, are we overbuilding, as you both have been talking about, and frankly, are we overestimating how quickly adoption will take place? Meta is different because they are not a hyperscaler. Maybe they would like to become one, and they're trying to sort of tiptoe into it. Nonetheless, it highlights some of the anxiety around the cost as well as just the supply of actual compute, given where we are in the AI build-out.
The stock rewarded for that reporting, that's for sure. Under surveillance this morning, taking stakes in corporate America.
I said to Intel, give the United States of America 10% of your company. He said, you have a deal. He said it so fast, I said I should have asked for more. That stake is now worth $80 billion. I made $80 billion for the country in 8 months. Does anybody talk about it? No.
So here's the latest this morning. The president getting a pitch to invest in another U.S. tech company. The Financial Times reporting OpenAI is in early talks to give the U.S. government a 5% stake. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome. Just get us up to speed on what's happening here.
Well, John, at the moment, this is really coming as the debate on how to balance the potentially massive gains from the AI boom with also the potentially massive risks is becoming an increasing large talking point here in Washington. The FT reporting goes on to say that OpenAI's pitch could also potentially include other top AI companies like Google, Meta, and Anthropic, also handing over a 5% stake, though it's unclear if the companies would do so. Importantly, the FT cautions that this is all in the preliminary stages, though we know President Trump has expressed an interest in the idea alongside a government-run wealth fund. And just as backdrop here, in the last month alone, OpenAI CEO Sam Altman was here in Washington on Capitol Hill, but also met privately with President Trump on the sidelines of the G7 summit in France. As a person familiar with the matter tells us that he first pitched the administration on this idea early last year. Now, the proposal, of course, coincides with what has been mounting pressure from this White House on top AI companies, as both OpenAI and Anthropic have seen recent releases of their models limited over government concerns. And John, just adding to the urgency is the midterm elections, as you guys were just discussing. To put a little bit of a finer point on how voters are feeling about the technology, a recent Reuters Ipsos poll released in June found that 53% of Americans are concerned that either their job or the job of somebody they live with could be at risk from AI, and 77% say they think the technology will increase their electricity bills.
That doesn't make this technology popular, that's for sure. Tyler will be back with us a little bit later. We need to talk about Apple and their lobbying efforts down in Washington, D.C. Peter Tchir still with us. Pete, we promised you would come back to this story. OpenAI is not a charity anymore. What are they getting in return if they give up 5%?
You know, I think you go back and look at what Intel got, right? Intel got a lot of support from this government. It came into the year, you know, you always get asked to do these stupid things at the start of the year. What's your favorite stock? We picked Intel, and part of that was based on the government support, the government need, and national security, right? We do need to develop these things. So to some extent, you make this make sense. And also, if this wealth is spread to the American people, maybe it shifts the, you know, polling against AI to say, hey, we're actually own some of this as a citizen of the country, so why don't we let this, you know, go better? So I think that's an attempt there. Again, all of this, you wish there was a better framework. You wish there were kind of rules set up on how we would manage the U.S. government's involvement in companies at stakes. We have none of that. It's still going to be very much directed by President Trump. And so whether you like it or not, you've got to figure out how does he play with it, what does he do, what's in his nature, and he was going to take, just like he talked about on that clip, he is taking full credit, and rightfully so, on how much money he made for Intel, on Intel for the American people. He's going to do that sort of thing, I think, with every stake. So some of this makes sense as a way to ingratiate yourself, both the administration and possibly the American people, given that backlash.
Is it a short-term gain, though, for long-term pain in terms of the precedent that this sets?
You know, I think we live in a world where everyone almost has to sacrifice short-term pain for short-term gain. So you kind of go through that. Again, it's very unclear. Again, over time, you would like to think that Congress or someone starts forming some actual rules about how the U.S. does this. But, you know, that certainly does not seem likely to happen anytime soon.
Would you like OpenAI and Anthropic more if the government had a stake in it?
You know, again, both of these are private companies at this stage, so we don't really know their valuation. So I think it's interesting. I think it's a neat thing to do. I don't know what precedent that sets for, like, every company that goes IPO. SpaceX should have done this. It all gets a bit weird, and we move one step away from the capital markets that we traditionally knew.
Pete, are they actually going to receive money for this stake? That's unclear to me at this point.
It's very unclear.
Are we actually talking about them going to the government and proactively saying, here's 5% of my company?
So I guess we will see. I've heard various things that they could donate it as a charity into the Trump accounts. There's all sorts of things that may come out of this. Again, Intel is different, right? Intel, there was actually money left over from the CHIPS Act that we were able to use. I believe with U.S. Steel, there was money that we could put to work. So this is different. Again, this is changing rapidly. Go back, though, whether it's the ballroom or other things, right? There has been a kind of a precedent that the companies that have involved themselves with this administration have done very well. So I think people are looking at it and saying, this is maybe better for our shareholders, and maybe it's better to give 5%. That I don't know. I'm not in that
I don't know either, but I wish we had the Bramo cam, as you and I were having that conversation. Lisa, this stinks, doesn't it? Something about it's just not right.
Especially following the $1.4 billion disclosure tied to some of the crypto holdings of the president. It really upsets me when you start to see real government involvement in market-based assets. The reason why I love covering markets is because there's a purity to them. It's collective wisdom of the crowds. Up, down, there is sort of a gut check that you get. And when you start to get government intervention, it really obscures that message, and it makes it very difficult for me to stomach because I can't understand the motivations, and I don't get a sense of that sort of pure market dynamics that, frankly, is what I live and breathe.
Nothing is free. What OpenAI and Anthropic want is they want to be in the driving seat when it comes to the future of this technology in this country, the regulation, especially because they're seeing the Reuters poll, the Pew Research on how the American people feel. What they will model it after, though, potentially, according to the Financial Times, is the Alaska Permanent Fund. Sovereign fund in Alaska. You take all that oil revenue and you give it back to this, individuals in Alaska in terms of stocks. It pays dividends. The government and the residents of Alaska. That's what they're potentially trying to model on. And I know potentially this president is acting almost as a Bernie Sanders president would act. But remember, this idea started actually under the Biden administration to create a U.S. sovereign wealth fund.
The senator from Vermont, I believe, wants 50 and not 5. I think that was his proposal.
But this is the direction of travel.
It's true. I'm right there with you. Pete, thank you, sir. Appreciate it. Thank you very much. Peter Tchir
Thank you very much.
of Academy, a fired-up Bramo. That's how we like it.
I just want a process. I want transparency and a process. I'm not saying don't do it. I want to understand what the parameters are, just as a random sort of.
What's left of capitalism?
Yeah, or just in
After
general.
central banks destroyed it.
Or what's left of policy.
What's left?
Procedures.
What's left? Entrepreneurship stays part of the national fabric. Entrepreneurship is what makes America great.
This much. Falling just short of a three-day winning streak on the S&P 500. Small pullback yesterday by a few tenths of 1%. Small pullback this morning, down by 0.1. On the Nasdaq, down by 0.5. As I've mentioned, though, and we've been talking about this, away from the index level, the sector level and single name story right now is fascinating. As we talk about the potential, and I stress potential, to really shake up this tech trade.
We talked about how there was a transfer of wealth, and you mentioned this many times, from the hyperscalers to the semiconductor names. Is that starting to shift, where people are questioning the cost and looking for cheaper options, whether it's looking to Chinese-made equipment or whether it's potentially to offload some of the compute capacity, which is what we're seeing from the likes of Meta? Either way, it's challenging the story that has upheld a lot of these component makers. Is the choke point shifting?
South Korea having a rough ride overnight. SK Hynix, Samsung, those stocks really suffering. The Nasdaq down by 0.5. Let's turn to the bond market just briefly. 2s, 10s and 30s. Yields reset at about 417. ISM a bit softer than expected in the last 24 hours. Payrolls 2 hours away. Look out to Japan as well. The long end of the yield curve here behaving quite well. Up a basis point, not behaving over in Japan in the JGB market. Some jitters there. You wonder what the potential is for spillover from Japan to Europe into US markets.
And we've seen this with respect to in the past few years when the Bank of Japan has had to be more hawkish. And when they haven't been more hawkish, when you start to see a bit of a bond vigilante experience in the long end of the yield curve, Japan is an interesting wild card. So far, the yen weakening has been somewhat contained. Watch out Friday. There's no trading in the U.S., just speculating, and you mentioned this yesterday. How much do we see a convenient time to maximize the effects of some sort of intervention?
A nicer liquid Friday just to step in and get more bang for your buck.
Yeah, so if you raise $70 billion, it might actually do something.
There you go. Dollar yen, north of 160, near a multi-decade low for the Japanese currency versus the US dollar. As we count you down to the open, about a cash open 3 hours away, let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We're seeing stocks, part of the AI infrastructure trade, extending their sell-off. After that report yesterday, are reporting that Meta is considering selling some of its AI computing power. And that, of course, has investors worried about competition and overcapacity. So you are seeing some of the biggest winners of the AI trade falling this morning. The memory names, with names like Micron down 2% after falling more than 10% yesterday at the close. Meanwhile, Alphabet shares are also weaker this morning, though trimming their losses down about 0.9% after Google lost its final appeal over a $4.7 billion EU antitrust fine. Regulators there said that the company gave Google Search and Chrome an unfair advantage by requiring its manufacturers to pre-install the apps on their phones. So Alphabet shares are falling in the pre-market. And Adobe is having a good day. Those shares up 3% in the pre-market on some sell-side action. HSBC upgrading the stock to a buy, and this extends yesterday's rally in the software sector after Guggenheim argued that investors have become too pessimistic about AI's impact on the sector. John.
Yahara, thank you. Thank you for the update. More from Yahara in the next hour. On our radar this morning, OpenAI in discussions to give the US government a 5% stake in the company. The Financial Times reporting the CEO, Sam Altman, proposing an arrangement for the US to hold stakes in several AI leaders, including Google, Meta and Anthropic. Elsewhere, Apple entering talks with Chinese chip makers as it faces soaring memory costs. The tech giant in negotiations with firms on a Pentagon blacklist, risking significant blowback from Washington. And finally, Meta developing a major push into the cloud business, planning to sell excess compute power and AI model access directly to outside developers, positioning the social media giant against established cloud titans AWS and Google.
We've been talking about what the implication is, and I would add a point to it. Is this an implication for Meta specifically or the broader infrastructure of tech, right? And I think this is going to be key when it comes to not only the neoclouds, although there might be particularly leverage to Meta, but more broadly with respect to the hyperscalers. Meta is not a hyperscaler. They are trying to compete with the hyperscalers because they actually have the use case. And Meta's own internal AI models might not be gaining as much traction. And we've already heard reporting about how Meta's employees would rather use some other models to be more effective getting things done. Is this Meta's way of saying we took on too much compute based on what we are capable of it? Or is it a broader concept for the broader market saying there is too much compute and an overcapacity more generally for the market? The market is treating it as the former, not the latter.
Well, we need some context and go back to hear what Mark Zuckerberg has said about this in the past. In the third quarter of 2025, he first talked about potentially getting into the cloud business. And then in May, he said it's definitely on the table, adding that if Meta gets to a point where it's overbuilt AI infrastructure, quote, then that is an option that we have. So that is why for Meta, yes, this is exciting, a new revenue stream, but that is why the rest of the market is seeing this as maybe we have overbuilt.
I'm just tracking the change. A month ago, there was a report in the FT about Meta raising equity capital. Stock sold off. Raising equity capital. A month later, we're talking about a new revenue stream and selling excess capacity, and the stock rallied. Isn't that a big green light to the company to do one thing and not the other?
Right now, this is saying to the company, you need to show us where you're going to get your money, because right now you're spending more than we can see it coming in. And so it is a green light to do more of offloading compute and, frankly, doing other revenue saving or revenue boosting measures.
So we've all got lots of questions. I have too. Clearly for the neo clouds, this is excess competition, extra competition. That word excess again, extra competition, and maybe some excess too. Those stocks were down 14% on CoreWeave yesterday. That is not something we need to debate. Whether it leads to less spending is the debate right now, because the chip players got hit too, and you nailed it, the framing. Which one is it right now? Does it lead to one or the other?
What we're hearing from all the analysts is that it's still an existential risk for the likes of Google, for the likes of Microsoft, for the likes of Amazon. At the same time, are we reaching the point of sort of peak spending and peak acceleration in spending? A lot of people say yes, but are they sort of forced to curtail their spending that much more as a result of market action?
Meta this morning with the smallest bounce were up by 0.2% at the pre-market. CoreWeave and Nebius among the cloud giants impacted by Meta's compute plans. Stefan Slowinski of BNP Paribas writing, we believe there will be long-term demand for more than just hyperscale infrastructure providers, especially as open source models gain momentum. Stefan, welcome to the program, buddy. Let's just get your initial reaction. You saw the story from Bloomberg yesterday. Meta rallied off the back of that. You saw the stocks that sold off. What was your initial response?
Yeah, good morning. Thanks for having me on. I think, as you've covered this morning already, there's a few factors swirling. First of all, the market's very nervous. Everyone's kind of crowded into these hardware stocks. And for the past 3 years, every time they try to diversify away from that into software, into other areas, they get punished for doing so. It's kind of like Charlie Brown and Lucy and the football. And, you know, is it different this time? Is it potentially time to pivot? That's what investors are asking themselves. I think on the infrastructure side, the question around Meta, again, as you've covered, is this a signal that they don't have confidence in their own AI strategy, that they want to hedge themselves by potentially offering their compute? Or is this just a smart future diversification? It's worked for Amazon, it's worked for Google, it's worked for Microsoft. If you're going to be spending money on your own models, if you're going to be spending money developing your own silicon, your own proprietary chips, well, you may as well amortize that not only across your own first-party applications, but potentially across an enterprise customer base or a cloud computing service. So right now we don't know, but of course the reaction by the market just shows the nerves that are out there.
How much is this story affected by open source models, in particular coming from China, which has been pioneering a lot of those, given how much cheaper they are and the fact that they're catching up pretty quickly to some of the enterprise models coming out of the U.S.?
Yeah, and again, this is a theme that's been bubbling for the last couple of months. We've been talking about it at BNP Paribas in our research, which is going from token maxing to token optimization to token capping. We're actually seeing some enterprises cap the usage of these tokens. You're seeing people like Alex Karp yesterday from Palantir talking about how enterprises are pushing back on the cost of the big LLMs. You saw Amazon Web Services recently referring to enterprises' use of AI like using a Ferrari for the school run, which is 95% of what enterprises are using frontier models for. They could do much cheaper with open models. In addition, for some of the things you've raised this morning, whether it be independence of these large language model providers, over-reliance or dependency on one of them when maybe you won't get access to the next model that's released, or OpenAI and Anthropic increasingly going into industries themselves. Yesterday, we saw OpenAI moving more into personal finance. We saw Anthropic moving more into healthcare and pharma. You know, all of these things are maybe making enterprises a bit reluctant to hitch their wagon to one of these providers and seeking more open models that they can bring onto their platform, protect their data, and use internally for most of what they want to do in AI. And again, the question is, that could be good. That's the old Jarvin's paradox of AI accelerating usage. But how does that play out for OpenAI, Anthropic, and all of their spend and the wider AI ecosystem?
I'm glad that you're bringing up Anthropic and OpenAI. It seems like there's a real question in markets right now of who's the most vulnerable to this trend, this move toward open source and looking for optimization of the tokens. Some people might say it might be a Meta, which hasn't really gotten entrenched with some of its LLMs or its programming yet. But couldn't you argue this is a real liability for Anthropic and OpenAI ahead of their IPOs, given how much of a lead they have and the fact that their models are closed?
Well, they do have open models as well. So that's interesting. OpenAI has their own open models. And so they are potentially looking to promote those as well. There was some reporting a couple of weeks ago that maybe OpenAI was looking at cutting some of their API prices. Of course, Anthropic just came out with a new model that allows you to do advanced agentic AI more cheaply. And so they could trigger them to change their pricing models to try to become a more full service provider of open models and closed models and for whatever the customer may want. But certainly, I think that the business model long term continues to be a question that investors have. And I think when you look at the hyperscalers, you look at Meta trying to get into this space, or even CoreWeave and Nebius that you started off with, these platforms are now thinking about how do we shift from providing infrastructure just to AI labs or to other hyperscalers. And let's move towards providing this infrastructure to enterprises, providing them with a platform where they can train their own model, use their own model, protect their own model and data for their own purposes. And so we're seeing a company like Nebius really trying to move in that direction, which is a place for enterprises to deploy open models.
Stefan, why do you think a company would want to give away a 5% stake?
Well, I'm sure there's strategic reasons behind it. As we've seen in some of the debates just today with Alphabet and I think the European Union, it's important for some of these big U.S. tech companies to feel that they have the backing of the U.S. government globally when they're interacting with governments and regulators. And of course, if governments, including the U.S. government, are going to get more entrenched and involved in looking under the hood of these models and these technologies, then a more closer relationship with the government potentially makes sense. And of course, governments are also going to be very big customers for these AI labs. So there's lots of strategic reasons. As I mentioned before, there's also a flip side, which is potentially could be perceived as losing independence. And especially outside of the US, when there are other open options, as you mentioned, that potentially could have some negative strategic consequences.
Stefan, it's good to catch up with you, buddy. As always, a lot of unanswered questions this morning. Stefan Slowinski there of BNP Paribas. Did we just learn something about the AI thesis, or did we just learn something about Meta? So let's start with Meta. You went there, Lisa, and I'm pleased you did. For Meta, it's difficult not to conclude that they have decided, based on that reporting, and we'll see if they go through with it, but difficult not to conclude that they have decided that the ROI on renting out capacity is higher than using it internally. If they go forward with this, hard to conclude anything other than that conclusion. The next question is, does this have a chilling effect on spending elsewhere? Because of the move we saw in the price of Meta yesterday in the stock market, do others look and say, you know what, maybe we should do the same thing? And does it have a disinflationary effect on the overall cost of architecture for this massive trade? They're the unanswered questions this morning. I think the market has made a decision, to your point, about it being one versus the other. What it looks like in the next several months, I've got absolutely no idea.
And two ideas can be true in parallel. Meta can decide that it is a bigger ROI to rent out the compute to others than to use it for their internal models. And you can see a disinflationary effect taking hold across the industry as rationalization takes hold. And you're seeing that with OpenAI and some of the reports about them cutting prices on models and some of Anthropic's moves. A question of how much is this a huge signal versus just the natural evolution of a technology and the whole Jevons paradox because more people are using it. Again, it will be a debate heading into a summer where a lot of people are heading on vacation, so you might see a lot of volatility.
Sure. Look, I'm sure a lot of people who cover Meta will say this is not a strategic shift. It's an opportunistic pivot to raise some capital to eventually reinvest that capital further down the road and do the same thing. I don't know. We've got to wait to hear from the company.
I mean, what's the difference? It's just a matter of what,
sure,
strategist you have to try to massage the message. Either way, clearly, it seems like their models weren't taking off to the degree that they would like.
And either way, the stock liked what it heard yesterday in that reporting. Meta up this morning by around 1/3%. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The US isn't renewing the USMCA trade pact. Trade Representative Jemison Greer telling Bloomberg the Trump administration won't rubber stamp the agreement, which is scheduled to last another 10 years. The US instead will conduct critical annual reviews of the pact. BYD is set to reclaim the title of the world's top seller of fully electric cars from Tesla. The Chinese automaker delivered more than 550,000 battery electric models in the 3 months through June. Analysts expect Tesla to report quarterly sales of just under 400,000 next week. In sports, Team USA back in the round of 16 at the World Cup for the first time in 24 years. The Americans beating Bosnia and Herzegovina 2-0. They will be without their top scorer, though, Folarin Balogun in their next match against Belgium after he was given a red card. And that is your Bloomberg brief. John.
A questionable decision there. Questionable. Ridiculous?
I think so.
I don't like the slow-mos.
It's a very contact sport.
I don't like the slow-mos. I think that you have to sort of experience that in the speed at which the game was played to understand whether that was reckless or not. When you slow things down, it always looks worse.
Yes, and they were fighting over a ball. Like, what do you expect?
An early gift from Team USA for the US of A. Let's put it that way. Just a beautiful gift into the weekend.
250.
It's
right?
Rigged. It was a rigged red card. No, I'm just saying.
Right.
This is
still one, Brett,
Yeah, it was still one. It's amazing for Team USA. Truly amazing. It's just annoying that we were down to 10 players and now the red card for the next game.
It's good drama.
It's frustrating.
It's good reality TV.
Staying up next week to watch the game?
Maybe.
Yeah.
Not.
Oh, yeah.
Maybe.
All
Yeah,
right.
we'll see.
Let's talk about the Fed. Up next on the programme, a tight-lipped Fed chair.
I want us to have a good family fight when we meet. When we get into that room and shut the door, we're going to have a good debate, but I don't have much more for you than that.
Up next, we'll catch up with Marc Giannoni of Barclays. Stocks just about unchanged heading into payrolls later on this morning. Under surveillance this morning, a tight-lipped Fed chair.
At my press conference, I said, I'm not going to give forward guidance because we're meeting in 6 weeks, but I have an update for you. We're meeting in 4 weeks. I want us to have a good family fight when we meet. There's a lot of late-breaking news on a series of these things. When we get into that room and shut the door, we're going to have a good debate, but I don't have much more for you than that.
So here's the latest this morning. There's not much. Fed Chair Kevin Walsh dodging rate decision questions ahead of payrolls. Marc Giannoni of Barclays expecting the central bank to stay on hold through 27, writing the combination of still elevated inflation and labour market near full employment does not justify easing policy at this stage. Marc joins us now for more. Marc, good morning.
Good morning.
Does it justify tightening policy?
Well, the market seems to increasingly believe that. We don't think it's justified at this point.
Why not?
I mean, payroll employment has been very strong, and we'll have more of a signal this morning. So that should be a source of concern, especially in the context of elevated inflation. But we expect payroll to slow quite a bit in the second half of this year. We expect consumer spending to slow quite a bit in the second half of this year. So in that context, I think it's wiser for the Fed to wait.
What's the catalyst for that?
For the strength in
for
the
lower,
last few...
For lower payrolls, for lower spending?
So we think there were some idiosyncratic features in the spring. So from basically March, April and May, we had really strong payroll gains that were really affected by a range of idiosyncratic factors, some seasonal adjustment, but maybe the FIFA World Cup played a role as well. So we'll have to see the back end of that to see what happens when some of these job gains maybe get put back out of labor. We also, on the consumer side, we've seen real income of households actually decline over the past year. So it's down over the past year, it's down over the past 3 months, over the past 6 months. So I think that means that households, in real terms, see their purchasing power really being compressed. And that means that consumers are not going to be able to increase their consumption at the same pace as they've seen before. So we expect a significant slowing to about 1.5% or so.
In this era of no forward guidance, people seem to have discounted the labor market report altogether because there is this feeling that A, the numbers have been super messy, we don't understand them. B, it all is about inflation right now. And C, we're not going to find out from the Fed what their reaction function is anyway. So most people are keeping one eye on that and one eye on the beach. Do you think that that's the right approach?
Well, I think the lack of forward guidance is going to be something that we'll have to learn to work with. For some, I mean, I'm concerned that this might create a little more volatility going forward as market participants have to, form some expectations about what the Fed is going to do in the next several months. They have to price things one way or the other. And whether the Fed gives guidance or not, there's no way around that. So that means that without forward guidance from the Fed, there's more room for market participants to misinterpret some of the Fed's intention. And in particular, when the Fed, in its latest statement, was very succinct and focused very much on just the inflation mandate without any reference to the employment side of the mandate, maybe that is not quite what they meant. Maybe the employment side of the mandate also plays a role. And so, we would expect the market to be responding quite strongly to some of this.
Yesterday, Fed Chair Warsh did say that inflation expectations have trended lower, just an objective fact if you take a look at market-based expectations. You also saw the ISM prices paid component come to the lowest in about 4 months. I'm just wondering if there's anything in this labor market report, maybe wages increasing at a certain pace, that would make you think that July was still in play.
I would say yes. I think if the labor market is really strong across the board, wage gains, I think this is it's probably too early to see wage pressures to really manifest themselves and raise really the inflationary pressures. This is something that we would think is way down the road, like end of 27, 28 story. But I do think that if the labor market comes out really, really strong, broad-based, and that's followed by another strong CPI print that surprises to the upside, I think market expectation might be rising. And in a world where the Fed doesn't provide any guidance, meaning doesn't push back against these market expectations, we might be in a situation where July you have market expectation, let's say it's 75% probability of a rate hike. And then for the Fed, it's going to be kind of interesting decisions to make. Do you want to really surprise the market and not hike when you think that the economy is going to slow maybe later on? Or do you, and therefore surprising the market, and then the market is going to be questioning again how serious you are about the inflation? Or do you actually go with and validate the market expectations? So I think if I think about a risk to a hike, that risk is most pronounced for July, if indeed the data are coming quite strong.
Did you get a sense he was a little bit more dovish yesterday as opposed to his press conference?
I mean, my sense was that it was almost a repeat of what we heard during the press conference, with the minor caveat, which goes in your direction of like energy prices having fallen, right? But energy prices did fall quite substantially. So I think that's the change in terms of the headline inflation, but impact. But I don't think it changes anything in terms of their view about core inflation or anything like that.
Dad jokes and family fights coming up at the next meeting in a few weeks' time. You excited for that?
Oh, yeah.
Right.
Big time. Well, it's just, I think
4 weeks away.
People are looking. We did find out that Mervyn King is going to be leading one of the task forces. That was real news. We're getting a sense of international cooperation, not exactly a go-it-alone kind of Fed. So, you were asking what kind of reception he would get. He certainly seemed very happy to be there. And
I always found it just ridiculous.
I mean, he's an establishment
dude.
Yeah. I mean, he is an establishment dude.
Right. He's got lots of support from other establishment dudes.
But going to take some radical steps, and this is what the market's trying to have.
So radical it is.
They have a lot of feelings. The market right now is not really sort of squaring their
not
feelings.
Freaking out about this. I think all of this matters at big turns in the economy, and it's not clear we're at one right now. What are we pricing at the moment? Like one hike? And what's the big spread on Wall Street? Like one hike or a hold?
Yeah. I agree with you.
Not a story.
I would agree with you. The Fed doesn't play a big role at points like this, and so ultimately he has a free pass to tell dad jokes and to talk about family
Free
fights.
pass for now at least. Enjoy the summer. Marc, thank you, sir. Marc Giannoni there of Barclays. Coming up next, we'll catch up with Priya Misra of JPMorgan. We'll catch up with Ariana Salvatore of Morgan Stanley, Luria of DA Davidson, and Nela Richardson of ADP.
we've seen strong earnings across most sectors, and we've seen the markets perform well across most sectors.
There is no lack of desire and demand in these markets, even when you're getting balance sheets that maybe aren't that strong.
When you think about the performance recently, really strong first half.
This market is just beholden by tech and AI and everything related.
The operative word remains resilient.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equities unchanged on the S&P, slightly negative on the Nasdaq 100, down by a third. Heading into payrolls later, your bond market shaping up as follows. 2s, 10s and 30s. 2s this morning at 417, just about unchanged. At the long end of the curve, some jitters in Japan. Not really spilling into the US market, up only a single basis point on 10s and on 30s. Looking ahead to payrolls, your estimate as follows. 113 in our survey. That is the median estimate. That's down from 172. That's the backdrop for the labour market. It's okay. For inflation, there's a bit of a problem.
Yeah, especially considering that you've seen just the highest print going back some 5 years in the latest CPI print. You do start to wonder, what is a good print and what is a bad print? I'm old enough to remember when people were talking about the break-even rate on jobs being something like 40,000, 20,000. Or zero. And that might be enough to keep this at a full employment market. Let's say we get the whisper number right now, which is about 99,000. Let's say we get the whisper number, a disappointment, but you have the unemployment rate incrementally tick lower. How does the market treat that? How does the market understand whether we're in a fully employed, whether we're in an accelerating or whether we're in a decelerating market? Maybe Kevin Walsh is saying just ignore it all. The market, I'm sure, will not. Key question is, how much does this lead to truly a slowdown in the second half, as some people think, or potentially a reacceleration?
And quite a range, with Citigroup wanting 25K. Bloomberg Economics, Anna Wong, is talking about 200,000 jobs added. Leisure, hospitality, what is going on in this country when it comes to the World Cup, hosting these massive games? But when it comes to does it even matter? Because Kevin Walsh yesterday was basically like, it's government data. It's 3 months behind, then it gets revised 18 months later. So if he's not reacting to it, should the market just almost look through it?
It's a hawkish head fake because of Scotland fans up in Boston. Is that what we're saying?
Yeah, for bartenders.
Right.
Yeah, bartenders.
I like those fans.
Weren't they great?
They're amazing.
Dutch fans were great too.
Yes.
So which fans don't you like?
Not going there. Futures this morning, unchanged. Markets.
That was the key question.
I make some stupid comments sometimes. I'm not that dumb, especially not this morning. Let's talk about a tech trade as well. Meta. Is Meta upending this tech trade? Some fantastic reporting from our colleagues here at Bloomberg. Meta proposing, renting out excess capacity. And the key word here is excess, when we've spent a long time talking about constraints and scarcity.
If this were Amazon, if this were Microsoft, if this were Google, this would be a very different story. I think there would be a bigger existential angst around what this meant for the hyperscalers, for the cloud computing, for the semiconductors. Are we reaching the end of investment? The fact that it's Meta adds an interesting spin, because Meta has been going through something of an identity crisis for a while. They were going to be the metaverse. Well, that didn't happen. And then all of a sudden they were going to somehow play in the AI sphere, but they're not hyperscalers in the same kind of way. So they can't necessarily provide both their AI models with some sort of infrastructure the same way, even as they got compute power. So all of this coming together, people are saying, we're confused, what are you? And they're saying, we're making money off here. And people got very excited. So how much is this a Meta story and how much is this a more global tech story?
Stock was in a bear market, not just Meta, Microsoft too. They were selling off, they were spending lots of money, and the beneficiaries were the big chip players. Reversal. Meta rallies 8-9%, Cosby sells off around 8%, SK Hynix, Samsung. I've got more questions than answers, unfortunately, this morning. Does it have a chilling effect on spending elsewhere? Does this lead to a deceleration in CapEx? What does it mean for the disinflation for the whole AI trade? We're talking about pricing power, higher prices and scarcity. Are we starting to see a shift here? And that's going to be the big debate, not just this morning, but through the next few weeks.
And adding to the SK Hynix and Samsung story is the idea that Apple is looking to some memory chips, memory sales in China to diversify away from Samsung and SK Hynix. So the pricing pressure coming from a multifaceted backdrop, which is part of the reason why people say prices can't stay at this level. Can acceleration in adoption overcome the declines in revenues that you're going to get on a per company basis?
Not a great 24 hours for the chip names following a record-breaking quarter. for the chip names. Futures this morning down by 1/3%. Coming up this hour, we'll catch up with Priya Misra of JPMorgan with stocks adding to losses ahead of the payrolls report. Ariana Salvatore of Morgan Stanley as OpenAI attempts to ease growing pressure from Washington. And Luria of DA Davidson on the ripple effects from Meta planning its own cloud business. We begin this out with stocks failing to find a firmer footing to start the second half of the year as focus begins to shift back to the jobs data this morning. Priya Misra of JPMorgan writing, it will be important to look under the hood and which sector is driving jobs to see if the pace of job creation is broadening and or becoming a source of inflation. Priya joins us now for more. Priya, good morning.
Morning.
What did the early indicators suggest?
So I would say it's still not really, the labor market doesn't seem to be a source of inflation here. You know, we're looking at wage numbers. They're not really picking up. The unemployment rate hasn't been falling. We're in this low hire, low fire economy. There's a massive AI trade. You know, there's this sort of K-shaped consumer. So, you know, but we've had a very resilient economy, and we've had lots of shocks. You know, between the oil shock, between tariffs, between 500 basis points of rate hikes, and the economy has been resilient. So I think the big question, you were just talking about the shifting narrative. I think there's also a shifting narrative in the macro, world. That is the labor market re-accelerating. You know, we've had 3 months of solid growth. Are we at the point where the labor market's about to take off? The growth is broadening out. If it's broadening out, then we should be talking about a higher neutral rate. We should be talking about Fed rate hikes. We're not convinced we're there. I mean, we're expecting some slowdown, but you have to look under the hood. I would push back. I think the labor market's extremely important. I know if you just watch Chair Walsh, you might say it's all about inflation. It's about trend inflation. He's actually opening the door here for, we may need to look at more data. We may need to look at that trend number. And that's where the labor market comes in. So watch under the hood. Is this still really AI and sort of these secular things? We're all getting older. So, you know, if it's all healthcare, I wouldn't say that that's a source of inflation. Do we see broad-based, job growth? I think then we would say hikes should be really on the table.
Do you think we're close to that?
I don't see that. I still see hiring trends remaining low. You know, we look at all sorts of, whether you look at consumers, so if I'm in the market looking for a job, those numbers are weak. So sentiment numbers are weak. If I look at companies, what are you doing with all the money you're raising? CapEx. I still don't hear hiring. So I don't think we're there. I mean, let's see, the numbers are noisy, so you can always get that World Cup effect in a high number. But if it's all leisure, hospitality, if it's healthcare, I'm not convinced that we're at the point where the labor market's about to take off. But I think that's the key question, especially as we sort of contemplate rate hikes in a no forward guidance or no framework guidance world.
You know, what's interesting is in the ADP report, it wasn't coming as much from leisure and hospitality. I don't know what we can read into it from that. How much will it matter to you if suddenly we see people being hired to build out data centers, to do construction work, to do some of the highly technical mechanics? I mean, how much do those jobs give you a sense of positivity or not, right? Is that a broadening out or is that the same trade?
If you just show me it's construction and it's really non-residential constructions, that's data center, I don't know if I would be convinced that this is broadening out. It would be good. Every job is good. But is that a source of inflation that the Fed might want to clamp down or, you know, in this focus on price stability, we'll need to push back again? I guess that's what we'll be watching. And do you see that showing up in spending? Look at personal consumption this year. I mean, despite the resilience, personal consumption is actually slowing. So I'd like to see the broadening out of the job gains as well as personal consumption picking up, not just the upper part of the K, but some broadening out as oil prices decline. Do we see that tailwind for the consumer? And then, you know, that might make us more positive, think that the Fed may have to raise rates. And then I think the market's going to struggle because how much are we talking about raising rates? You know, because without forward guidance, is it just a mid-cycle adjustment? Is it risk management hikes or is this a hiking cycle? I think the market narrative will shift. I'm not even sure risk assets will love that. I mean, the rates market will price in some risk premium of rate hikes, but I think you will need to see that consumption along with the broadening out of job gains to get there.
Is there anything, I'm going to ask you the question that we were talking about with Marc Giannoni. Is there anything you could see in this labor market report that could put July in play?
Oh, wages. If we see a pickup in wages, and I would like to see that along with, you know, no sort of seasonal impact or this is just driven by one sector, then I think July, you know, the market's going to price in, there's risk premiums now that I think we all have to get used to higher risk premiums. You know, Chair Walsh says that the market is a pure way to see it, but if you're not sure of the reaction function, you're not sure what is that trigger point for the Fed to actually raise rates, then at that point you're going to price in that, some decent chance of a July hike. So wages, hours worked, broadening out. And then, of course, we have CPI in 2 weeks. So we'll be watching that. If you see core services starting to pick up, and it's not just software, but it's actually broader, every service that we spend, then that'll be a sign that maybe the inflation pressures are not just oil, because we know headline inflation is going to be negative. I mean, most likely month over month. But if it's broadening out, I think then the Fed will, they've sort of tell us that they're getting a little impatient with being above target for this long. I think the market then brings July in play.
Does this meta story actually help them? Because Kevin Warsh almost yesterday admitted that AI is inflationary in the short term.
I'm glad you bring that up. I mean, I think Kevin Warsh he said it a little bit in the press conference, and he brought it up again yesterday. I think the Fed, it's easy for us to see the demand side of AI. It's showing up in data centers, showing up in software prices. The supply side is unknown. I go back to the 90s. It took a long time to show up in the productivity data. Chair Warsh is bringing that up. He brought it up again yesterday. So I don't know if it's the meta story or a broader, but if there's a sense that the pricing power aspect is there, but you're seeing the pickup in productivity, you don't need to kill growth. Then you don't have that cruel choice to make. Productivity is picking up. This is something we were debating. We just had our quarterly, meeting for fixed income last week, and we were debating the expansion is there. We feel good about the expansion. Is it productivity leading, or is it inflationary? And that has implications across asset class. I think we're more in the productivity camp, but we have to see that in the data. And I think wages, hours, all of these consumption would be one source of that.
Well, let's go there. If we get a meta shift, is that a bullish development for bonds?
I think bonds actually look good. I don't want to talk my book, but you have look at the income. Look at the income you're getting in fixed income, and I will highlight how much. I mean, income's back. Real yields are positive. You've had 30% higher investment grade corporate supply this year, and spreads have been remarkably stable. So people are voting with flows. They're looking at all-in yields of 6%. And, you look under the hood, there's a lot of dispersion. High yield, investment grade, we can get high-quality investment grade paper close to 6%. So I think fixed income, I would generally say that there's a case to be made. I think if this is just I would argue, look at the economy, it's AI, a lot of it is AI driven. So if some air is coming out of that balloon, maybe people are going to say, okay, I'd like to see broadening out. If I'm not convinced, maybe bonds, risk-adjusted yields, you're giving me 6%, that looks attractive. So short, a long answer to your question, yes. But I would say it's attractive even here, and that's why we're seeing the inflows.
Priya, it's good to see you. It always is. Thank you. Priya Misra there of JPMorgan on this Payrolls Thursday, looking for 113. That is the median estimate in our survey. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. OpenAI is discussing giving the US government a 5% stake in the company. The Financial Times reporting the CEO, Sam Altman, is in active talks with the government. His proposal includes the possibility of Washington also taking a stake in other US AI developers. The SEC is looking into Susquehanna's allegations that unknown insider traders made $100 million on options bets ahead of a Chinese regulatory crackdown. Susquehanna said in its suit that it lost more than $70 million as counterparty on most of the alleged insider trades. In sports, Team USA back in the round of 16 for the first time in more than 2 decades after beating Bosnia and Herzegovina. And Belgium mounting a stunning comeback to beat Senegal in the World Cup. England also coming back to beat the Democratic Republic of Congo. And that is your Bloomberg Brief. John.
Heartbreaking for Senegal. Just heartbreaking. Did you watch that game? I turned it off near the end. I thought it was over.
I didn't watch the game. I know. I can't
Absolutely
keep up. I can't. How do you have the time? I don't understand. It's very, very difficult.
Just dip in, dip out.
Yeah, that's true. I guess I need to watch the clips.
The game's in the afternoon. Usually I have the terminal set up and then another screen with the game on at the same time.
He's locked in. Yeah, locked in into which one?
So if I start saying stocks are up 2-2 or something like that,
Hey, Meta, you got a red card.
The notes are wrong. Up next on the programme, the art of the deal.
I said to Intel, give the United States of America 10% of your company. He said, you have a deal. He said it so fast, I said I should have asked for more. That stake is now worth $80 billion.
Up next, we'll catch up with Ariana Salvatore of Morgan Stanley, live from New York City this morning. Good morning. Equity futures this morning just about unchanged on the S&P 500. Yesterday falling short of a third consecutive session of gains on the S&P. Some jitters in the tech trade re-emerge again this morning. The Nasdaq down by a third. Samsung, SK Hynix getting hammered.
Yeah, and this comes after a twofold 1-2 punch. On one hand, Meta that is going to be renting out some of their compute capacity, and that is being viewed for positive for them, negative for the neoclouds. And then again, Apple looking for other options to buy memory chips from in possibly China. Because guess what? They're having to raise their prices, and they want to rely on more than just Micron, Samsung, and SK Hynix.
And now OpenAI feeling very charitable. Let's talk about that. Under surveillance this morning, the art of the deal.
I said to Intel, give the United States of America 10% of your company. He said, you have a deal. He said it so fast, I said I should have asked for more. That stake is now worth $80 billion. I made $80 billion for the country in 8 months. Does anybody talk about it? No.
It's the latest this morning. The president facing the possibility of another deal with big tech. The Financial Times reporting OpenAI is proposing giving up a 5% stake to the U.S. government. Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Well, we're still waiting on some really critical details on how this potential deal would work in practice, though the reporting goes on to suggest that other top AI companies would have to be involved, too, including Anthropic, Meta, and Google, though at this point it's unclear if they would get on board in handing over 5% stakes. The FT cautions that this is all in the preliminary stages, though we've heard from President Trump before expressed an interest in this idea alongside a government-run wealth fund, and it would continue a trend for this administration. Plus, OpenAI CEO Sam Altman has really been on a lobbying push here in Washington, abroad, alongside President Trump. As a person familiar with the matter tells us that he first pitched the administration on this idea back in early 2025. Now, the backdrop here is that these top AI companies have, of course, been facing mounting pressure from this White House, as recently both OpenAI and Anthropic have seen the release of some of their new models limited over government concerns. And then, John, of course, there's the concerns from the voters, too, amid concerns when it comes to the job market, but also those higher electricity costs.
Tyler, we also know that Apple is courting the U.S. government about potentially buying chips from a Chinese company that's on the blacklist for the DoD. They don't actually need the U.S. government approval, but they want it. What's the latest?
Right. And Annmarie, this move could really risk drawing objections from the Trump administration, which chose to keep these two top Chinese memory chip makers on this closely watched blacklist. We'll have to see where it develops from here, because we're already starting to see that pushback, not from the administration quite yet, but from those hawkish members on Capitol Hill. We heard from Senator Tom Cotton, who sits critically at the top of the Senate Select Committee on Intelligence, who says that this would be a grave mistake, and added that it would, quote, risk long-term shareholder value, the privacy of their customers, and the security of this country. The thing is, Annmarie, is the administration doesn't want to see these companies purchase from abroad, even if it means raising their prices here at home. Instead, they're trying to push domestic manufacturing. I sat down with the Micron CEO just last month at one of his new plants just an hour outside of D.C. He told me this memory chip shortage is expected to last until early 2028.
Tyler Kendall with the latest. Tyler, thank you. Apple in the pre-market up by 0.4%. Ariana Salvatore of Morgan Stanley writing the following: AI and data centres are emerging as a genuine midterm wedge issue. The federal government will remain broadly supportive of the build-out, but with greater scrutiny. Ariana joins us now for more. Ariana, good morning. Good to see you.
Morning. Thanks.
Does that change if these companies give up 5% stakes?
Well, look, I think in that instance, what you're seeing is a broader shift toward industrial policy. And that in and of itself is nothing new, right? So that's something that we saw with things like the CHIPS Act. We see that through a mix of policy initiatives like the tariff regime, the 232s. So, I mean, look, I think it's no surprise that AI is unpopular with voters, right? Especially younger cohorts. And the reason that matters is because those are also the voters that have moved the furthest away from the president. So it's resonating in these elections, right? We're seeing candidates run on this issue. Voters are responding to that, and then they're getting engaged, and they're kind of participating on that basis. So we think the risk here is that this bubbles up from a state and local issue to something at the federal level. In general, we think the federal government's likely to still be supportive. Things like DPA reforms, permitting, energy, kind of alleviating that bottleneck. But this is something definitely to watch into November.
I'm glad you brought up the CHIPS Act, because Trump continuously talks about the Intel deal as something he can mimic Anthropic, OpenAI, maybe some of these equity stakes. But it was the CHIPS Act's grant plus some money from another DoD program that they were able to actually buy a stake in Intel, not giving one.
Right.
Do you think he is going to try to, the reason why he's talking about giving is because that's a different message for the American people they'd get more on board with?
So I think the messaging of this, it really kind of remains to be seen how people receive that. But the way I would talk about it is just another tool in the toolkit, right? So when we talk about carrots and sticks, we talk about incentives, you have things like tariffs, you have things like the CHIPS Act. I think what you're seeing is just kind of a full court press, like I said, on this industrial policy, what we call the new Washington consensus. It's not just in the US, we're seeing it around the world, right? So governments are deciding that national security is taking priority over economic efficiencies. So I think this is just really another example of that trend playing out.
Is there anyone in Washington who's lining up behind these companies to build out data centers?
I mean, I think that you're seeing broadly support for the data center build out, obviously, among the hyperscalers. We're seeing high levels of CapEx intentions there. But again, the voter pushback is a real concern, and we're seeing some moratoriums introduced on a state level. Like I said, something to watch. We think the way this is dealt with is through state and local governments either, requiring more out of these contracts. So it has to be conditional build out, right? So things like committing to grid modernization over the longer term, committing to more money up front or longer term contracts. We think that's kind of how this progresses as opposed to a full out ban at the federal level. It's just hard to see President Trump signing off on something like that, in our view.
Given the fact that we're talking now about the government taking stakes or getting stakes one way or another in some of these tech companies and some of these new ones, and you're hearing this on both sides of the aisle, is this the path of travel? I mean, for investors who you talk to, is this where things are going regardless of who gets into the White House? And these stakes, we haven't even talked about whether they're potentially controlling ones or not. I mean, how much influence does this have on the direction of corporations in the United States, which is sort of a celebration of capitalism?
Sure. I would say conceptually, this kind of is the direction of travel. I don't think it's necessarily a new thing that started with President Trump. We saw this going back to the Biden era and really Trump 1.0, right? So we saw President Trump impose the Section 301 tariffs on China. When those came up for the 4-year review period, President Biden, kept those in place. They rolled them forward. We saw President Biden issue a supply chain executive order focused on the same sectors that were the targets of President Trump's Section 232 investigations: semis, pharmaceuticals, batteries, et cetera. So I think conceptually there is support for this. Like I said, there's carrots and there's sticks and there's different tools in the policy toolkit to kind of get this objective. But overall, I think it's something that both Democrats and Republicans are on board for.
What counts as national security? Why is OpenAI national security?
Great question. That definition is broadening. It's changing every year, right? So when this, kind of first started, we started talking about export controls even a decade or so ago. It was really narrow, military end uses and those types of kind of high-tech applications. That's broadened out. I would say we saw an increase into biotech. We saw healthcare. We're seeing this kind of get wider and wider. So to answer your question, it's an evolving definition. I think it's going to continue getting broader as you see this economic participation throughout more sectors of the economy.
We saw this under President Biden too. As Ariana pointed out, everything was national security, and it looks like it is again.
Yeah, and even with the CHIPS Act, which was really popular on a bipartisan level, there were all sorts of little asterisks and ways that the money had to be used in specific ways. So even though people agreed with the theme of it, there were a lot of particular sort of other aspects to it that people were like, what is this? What is the purpose?
Progressive objectives, I think you're getting at.
I mean, yes, and I think that on the flip side, now you have potentially other objectives that are getting to it. It's just very hard to identify what the actual motivations are.
Slippery slope. Can be, at least. Ariana, we've got to go. It's good to see you.
Thanks for having us.
Thank you. You're wonderful. Ariana Salvatore of Morgan Stanley. Equity futures this morning just about unchanged on the S&P. Up next, Luria of D.A. Davidson. Equities unchanged this morning at the index level on the S&P 500 following a pretty muted loss in yesterday's session. Still on course for the biggest weekly gain since early May on the S&P. So far through Wednesday, up by 1.76% on the S&P 500. That can all change, of course. The payrolls report about 60 minutes away. On the Nasdaq, we're down by a third of 1%. Some tech jitters coming in, shaking up the sector and single name story. We'll talk more about the single name perspective in just a moment. In the bond market, 2s, 10s and 30s heading into payrolls. 2s at 4.17, unchanged. Not really much of an update from the Fed Chair Kevin Warsh and Sintra Portugal in the last 24 hours, but I guess the update is this, just acknowledging that inflation expectations have come back in, given the move we've seen in the energy space.
I love that his observation of just market dynamics and the fact that oil prices have come down are enough for people to say, wait a second, maybe he's not so hawkish. Nonetheless, what Priya and Misra said just moments ago I thought was really interesting. The idea that because there is a lack of clarity around the reaction function, there's extra premium that is built into the market and more volatility as a result. At what point is that by design to try to bring down longer term expectations?
To your point also, Bramo, this is the problem. When you reduce communication, the less you speak, the more emphasis people put on the things you do say.
Totally.
That really captures and highlights the last 24 hours.
I mean, he could have said ISM prices paid came in a little bit lower, a 4-month low. Everyone said, oh my God, he's going to cut.
He highlighted prices paid.
Right.
Right.
I mean, so this to me, right.
Come on, that's the story.
All of a sudden, that's
not suggesting that's a story, just saying like, that's what people do.
The emphasis is on the wrong syllable.
Right.
Yeah.
I'm with you, just about. Crude, Brent and WTI. Pulling back by 2%. Brent crude is 70. WTI.
The emphasis is on the wrong syllable.
67. No, we appreciate the correction. Thanks. But we understood. We're down 2% on crude this morning. Count you down to the cash open. 2 hours away. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We are seeing stocks linked to the AI infrastructure build out selling off again today on that story that we reported that Meta wants to sell access to its AI computing power, but that has investors worried about more competition and overcapacity. So it is hitting some of the biggest winners of the AI trade, the memory names. So Micron down 2.5% in the pre-market after falling some 10% yesterday. Western Digital and SanDisk also weaker. Meanwhile, after yesterday's sharp sell-off in Bitcoin, we are seeing crypto-linked stocks like MicroStrategy and Circle up in the pre-market as we see Bitcoin climb above 61,000. And we end on a call from our next guest, Luria over at D.A. Davidson. We're seeing Palantir rising 3.75% after he upgraded the stock to a buy, saying it's gaining a competitive advantage as AI companies like Anthropic face increasing pressure from Washington. That follows a week of back and forth between the company and Washington over Anthropic's most advanced models, just highlighting the tensions that we're seeing and that Gil highlighted. John?
Looking forward to catching up with Gil in just a moment. Yahara, thank you. More from Yahara in the next hour. On our radar this morning, OpenAI considering giving the US government a 5% stake in the company. The Financial Times reporting the CEO, Sam Altman, and other executives are proposing a broader arrangement where Washington takes stakes in several AI developers. Elsewhere, Bloomberg reporting Meta is developing a cloud infrastructure business to sell excess AI computing power and models.
Is this a signal that they don't have confidence in their own AI strategy? Or is this just a smart future diversification? It's worked for Amazon, it's worked for Google, it's worked for Microsoft. Right now, we don't know, but of course, the reaction by the market just shows the nerves that are out there.
The move putting Meta in direct competition with established cloud providers like CoreWeave. And finally, Apple in negotiations to purchase memory chips from blacklisted Chinese chip makers in an effort to help counter the global shortage. The outgoing CEO, Tim Cook, reportedly appealing to Trump administration officials to help soften the political fallout.
This is his full-time job, isn't it? Isn't Tim Cook now a full-time chief diplomat for Apple? And ultimately, this isn't clear that necessarily they're even going to get a deal with these Chinese manufacturers. But they're doing a two-pronged route here. Lobbying Washington, D.C., no surprises, managing expectations well, and then potentially also negotiating with some of these memory chip names. It makes sense from a logistics standpoint. It just question is how palatable will this be at a time where you're trying to sort of diversify your supply chain?
The one issue that makes it a little bit more palatable potentially to Washington is that these chips will be used only in iPhones that are in China. So your American iPhone, you won't get a Chinese chip. But at the same time, what have we seen out of Beijing for the past year and a half? They will use any leverage when it comes to rare earths or other issues on Washington in any sort of discussions or anything Washington needs. So why would you give them an edge at this moment?
There is signal in price. The whole point of having scarcity, and not just on this issue, I'm responding directly to what you're talking about, the spirit of it at least. The whole point of having a higher price and scarcity is to build out capacity somewhere else. And that's what we're trying to do in America, is build out capacity. So you should be using that price signal to achieve your objectives, your national security objectives, at home. I understand it's going to take some time, but ultimately, isn't that what we should be doing here?
Like focusing on creating a competitor to Micron, say,
right.
or to allowing them to build out. And that's currently what South Korea is trying to do with SK Hynix and that $880 billion for Samsung and SK Hynix to build out more memory chip plants around the country.
Apple this morning, up a third of 1%. That story is not going away. Let's turn back to Meta's push to sell AI computing power. Gil Luria of D.A. Davidson maintaining his buy rating on the tech giant, writing, if Meta slows down CapEx and starts monetizing it, we see significant upside to revenue and cash flow. It could stay in the AI race by going back to its open source roots. Gil joins us now for more. Gil, let's just run with the story from Bloomberg, from our team. We haven't seen it confirmed really by Meta just yet, but let's go with it. Would it represent a strategic change or just an opportunistic move?
It's a strategic change for Meta because they have been trying to compete in the frontier model race with OpenAI, Anthropic, and Google, and they have not succeeded. They spent $14 billion hiring Alexander Wang. They put out several 9-figure offers to labs, to employees at labs like OpenAI and Anthropic, and we're about a year later, and it hasn't borne any fruit. So they realize they're not competitive in the frontier AI race, which means that much of the data center capacity they've built is not being used. This is exactly the same situation Elon Musk found himself with SpaceX. He thought xAI would be competitive with OpenAI and Anthropic, and it is not. Maybe not yet, but it's not. They both have single-digit % market share where OpenAI, Anthropic, and Google are dividing up the market. Now, Meta has even more data center capacity than Elon Musk. And let's not forget, for SpaceX, at a run rate, they're going to turn around and lease out data center capacity for about $30 billion a year. Meta has even more than that. So it's really a windfall for them to turn around and say, look, Meta's AI products aren't as successful as we wanted them to be. We have excess capacity. We can turn around and sell them into the market at nearly 100% margin. It's a no-brainer, and it's a great move for Meta, either until they get a very competitive model or for them to just use this capacity going forward to just sell it to third parties that are willing to pay for it, and they are willing to pay for it.
So, Gil, do you expect others to follow? So we've seen it from SpaceX. We've seen it from Meta. I remember a number of months ago when Microsoft was punished for using their capacity for internal needs and not being able to meet the demands of customers externally. Do we see the shift from Microsoft too?
Not at all, because that's exactly it. Microsoft, Amazon, and Google, they have all the customers. They don't have enough compute. That's why they're in a race to build out as much compute as they can and go get it elsewhere. Meta right now was only serving it internally, so they didn't have enough demand for it. Microsoft, Amazon, and Google have more than enough demand. That's why they are signing 3-5-year deals for data centers they haven't built yet. And they're signing them at a big markup. So they're going to be happy with to continue on that path. Their challenge now is that Meta is going to put more supply into the market. So that's going to reduce their pricing power a little bit. So that's the drawback for the big three, but they still need all the data centers they're building.
Gil, do you think that the market's running out of patience when it comes to some of these CapEx spending plans from the hyperscalers, given the fact that a lot of the increases have come simply from component parts that are inflating to the moon?
The market has definitely run out of patience. You can see that especially in Microsoft's share price, but also in Amazon to some extent. But the companies are in a tough situation because they're looking at what I just said, which is, look, we're pre-selling these data centers at a big markup. That's a good return on investment. We know it is. We're looking at the spreadsheet. We just need to convince the market of that because the market right now is saying, no, you're not getting good returns. And they'll have an opportunity to do that. When Microsoft reports in 3 weeks, they're going to report an acceleration in Azure from 40%, mind you, on a $100 billion business. And they're likely to guide to CapEx growth in their next fiscal year that's lower than their CapEx growth this year. So they're going to be able to show the market that they can take their cash flow from this point and accelerate it based on this investment, that the investment is starting to pay off.
Who do you think of all of the tech companies suffer the most for this new trend away from token maxing to token optimization? The idea that increasingly companies are saying you need to have a good use case and you need to use selectively some of this compute power.
Well, I'll tell you who the winner is. That's Microsoft. Because guess what? When we say orchestration layer, What we mean is Microsoft, because Microsoft Copilot, which is on almost all of our desktops or laptops at this point, is how companies control what model is being used. In your Copilot, you have a drop-down between Claude, Opus, 5.5, 5.6, and eventually open source models. And Microsoft's going to control that. They're going to provide that service. Because guess what? Companies are learning they should not build on top of Anthropic or OpenAI, because what happened to Anthropic just a couple of weeks ago, their model got pulled. Guess if you built your business on top of an Anthropic model and gets pulled, what happens to you? It's catastrophic. So you need this orchestration layer, and Microsoft is in the best position to provide that to consumers.
But Gil, isn't that story potentially changing? Is the U.S. government going to be pulling models if they have stakes in these companies?
Well, first of all, they don't have a stake in Anthropic yet, right? Anthropic has been downright belligerent with the U.S. government. We had that episode in February around the Department of War. We just had this episode around Fable. They're belligerent with the U.S. government, which is very dangerous for them. It's going to preclude them from a lot of business. But even without the government pulling a model, what we already have had is OpenAI and Anthropic limiting the use of model to some companies, which means that they could pull the use from those companies if they wanted to. They have too much control, and it's unclear that government ownership in those companies is going to change that. So if I'm a CTO at a company, if I manage the IT and the AI budgets, I'm very reluctant to give them
they were
any
forced to
control
pull
over my
this.
business.
They were forced to pull this because of export controls from the U.S. government.
No, absolutely. But before that, they limited the use of the model. And when they limit the use of the model, that also means they could pull the use of the model from any company. That if they're talking to the government about limiting how the government uses the model, they could definitely have that with a commercial entity where they tell the commercial entity, you know what, I don't like how you're using the model. And in fact, in Fable, they rolled out limits and in terms of how companies can use their model to make sure they're not competing with them. That tells companies working with Anthropic, working with OpenAI directly is a risk. You want to work with a company that will help you build a business regardless of what model is sitting underneath it, especially as we enter the open source model era, which will reduce costs a lot. So that's where we are today. Again, that's why the orchestration layer is so important.
Gil, before you go, just to put a button on it, put a bow on it, make it very simple. It's a bullish development for Meta. Saw that in the price yesterday. Who is it a bearish development for?
Oh, it's very bad for Nebius and CoreWeave because Meta has gone from a buyer of compute. More than half of Nebius's backlog is Meta. More than a third of CoreWeave's backlog is Meta, to a seller of compute. So that means even if Meta follows through on these agreements, which they may or may not, they could try to negotiate out of them, or they just don't renew them. Either way, that backlog is worth a lot less than it was a couple of days ago, assuming Meta follows through.
Those stocks got hammered in yesterday's session for that reason. Gil, good to see you, sir. Gil Luria there of D.A. Davidson. Thank you, buddy. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Oil extending its slide to pre-war levels as flows through the Strait of Hormuz increase and traders switch their concerns from under to oversupply. Brent dropping more than 40% from its peak at the height of the Iran war. WTI trading below $68 a barrel. Taiwanese prosecutors detaining 2 Supermicro employees over alleged shipments of NVIDIA chips to China. The company says 2 other Supermicro staff were released on bail but barred from leaving Taiwan. Investigators raided the offices of Supermicro Monday, along with 2 other companies and 6 homes. A massive heat wave spanning from the Midwest to the East Coast is causing life-threatening conditions. Heat indices climbing above 100 degrees in many areas, and overnight lows may fail to drop below 80 degrees, offering little nighttime relief. The extreme heat is expected to last through July 4th. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate the update. Up next on the programme, balancing the dual mandate.
The way we as a committee described the labor side of the mandate is we said labor markets are steady. We said the demand side of the economy was solid, but we've all looked around and we've seen that prices are too high.
Up next, Nela Richardson of ADP, live from New York City. You're watching Bloomberg TV. Stocks are positive, just about up by 0.1% on the S&P 500. On the Nasdaq, bit of weakness, not too much. We're down a tenth. Keep saying this, but it's worth repeating. The index level story is actually quite boring. The churn beneath from stock to stock. Say, look at the neo cloud makers yesterday getting hammered. The neo cloud companies down by double digits as Meta, on our reporting, is considering making the shift to competing with them.
What's fascinating is when you take a look at the VIX, at the implied volatility in stocks, it's come down dramatically. When you take a look at the single name volatility, it's gone bonkers. I mean, it really is the shifting narratives and this question of who's going to lose, who's going to win. We're talking about now suddenly the neoclouds, one of which is up more than 170% so far this year. All of a sudden, its one business prospect might be declining pretty rapidly if Meta isn't necessarily demanding it. Gives you a sense of how much is in flux and how much active managers just are incredibly happy this year.
Nasdaq looks like a snooze. It's not a snooze. We're down by 0.1% on the Nasdaq 100. Turn to the bond market. Attention shifting to payrolls later on this morning. 41 minutes away. Yields behaving. We are pretty much anchored around 420, 410 to 420 on twos. 417 this morning on tens, up a single basis point. Let's round this one up to 450. Under surveillance this morning, balancing the dual mandate.
When we met 2 weeks ago, I think the way we as a committee described the labor side of the mandate is we said labor markets are steady. We said the demand side of the economy was solid, but we've all looked around and we've seen that prices are too high, and I don't think I'm the only one on this stage that's recommitted to deliver price stability.
So here's the latest this morning. Investors awaiting the June payrolls report. The median estimate in our survey expecting 113,000 jobs added. Nela Richardson of ADP writing, hiring is still positive, but the pace signals moderation, not momentum. Nela joins us now for more. Nela, good morning.
Good morning.
That's an important difference between those two words. What's drawing that distinction for you?
May versus June in the ADP payrolls report. I was really excited by the May report. I was excited because it looked like finally hiring was broadening, and then June happened. The June data shows something opposite. We only saw 2,000 jobs created in the entire goods sector alone. And then when it comes to services, the MVP of the service economy has been education and healthcare, and they didn't put up the points in June. So we didn't see the kind of momentum last month, that we saw in May. And for me, that was disappointing because I'm looking for this momentum increase. It has yet to materialize.
The labour market's no longer a reason to cut interest rates. Based on recent commentary from this Fed, can you find a reason to hike?
Oh, I think the inflation story is very much in play. And yes, wages are not going to be the instigator of that story, nor were they when inflation was much higher. This is outside of the labor market. And in fact, when it comes to workers, when it comes to paychecks, it's the accumulation of all these price increases that workers are concerned about. That's why you see the downbeat sentiment. It's not that wages aren't robust. They are. They're just not robust enough to deal with the accumulation of price and inflation that we've seen rapidly over the last 5 years.
There are a couple of camps that are developing on Wall Street. On one, you've got the Bank of Americas that are pricing in 3 rate hikes for this year, calling for 3 rate hikes this year. And then you have the Citigroups and the Morgan Stanleys that think that things are going to remain on hold at best, or even a cut over at Citi because of a deterioration in a labor market throughout the rest of the year, through the second half. Do you see any signs of that starting, that kind of increasing slowdown in the pace of hiring?
The labor market's steady. This is not a collapse of the employment picture. That is not what we're not even close to that. The difference is between a pretty steady, slightly stagnant labor market, no hire, or low hire, low fire, versus dynamism. I want dynamism. That's what's elusive. But the other part of that scenario, a labor market that just falls apart, we're not seeing any signs of that.
Are you seeing signs of places that are getting more stagnant as a result of some of the AI developments? I'm thinking, for example, of more white-collar jobs that you might have an employee that's like, I don't know if I really want to hire somebody, if maybe I can get sort of a co-pilot operation to do the work for me. I mean, are you actually seeing that come through in the numbers, or is this all just completely hypothetical?
In some ways, the AI impact is very, very modest, because AI reshapes at the task level, not at the job level, and that's hard for us to get our minds around. We're used to looking at the labor market from a top down instead of a bottom up, but it does have impact in pockets. So we've partnered with the Stanford Digital Economy Lab, and we've seen an impact for early career in the AI-exposed fields. But that's just a temporary adjustment in my view, because the solution there is just to skill up the early career to the higher complex jobs that we are seeing growth in. So again, the AI impact is a more nuanced story. It's not this macro impact in the way that it's just frequently discussed.
Are we going to see the World Cup boost potentially today?
I think we saw it in May. Unfortunately, I think
that's it. It's over.
You hire ahead. You don't hire in the current month unless someone leaves, and then you replace them. But I think we've already seen that impact. Maybe it shows up in the BLS picture. We saw it in May with the ADP report. We saw a slight bump there.
So if that's over, where could we see any potential bright spots?
That is the million-dollar question. It was healthcare. And I always was concerned because we've been on this healthcare wave for like 3 years now, maybe more. Like, eventually, does that wave kind of crest? Are we seeing a crest now? I'm a little bit worried about who's going to be the next MVP because we don't have a great bench strength right now. Sorry for all the mixed metaphors on the sports, but we don't have a great bench when it comes to all these other industries waiting in line to take the lead on the labor market. So if healthcare moderates, not goes away, but moderates in hiring, there's not a clear replacement yet.
Nela, you're one of the best. Appreciate it. Thank you. Thank you very much. Nela Richardson there of ADP. To Nela's point, really narrow breadth. That's been a story in this jobs market for a number of months and maybe even a number of years. We were hoping we were getting that broadening. I hope you're wrong. You know, I don't usually say that, but I hope you are.
She's wrong.
Nela hopes she's wrong too.
I'd like to see it in the data.
Going into payrolls about 35 minutes away.
Yeah, and just a note that healthcare and education might have been the MVPs, but they were not loved MVPs because they are rather sort of agnostic to the market cycle and the economic cycle. So they don't speak to necessarily this huge upsurge in activity. So to the degree that they're MVPs, they aren't exactly the Lionel Messi of the world.
Nice.
They're sort of, others who potentially are rivals that are less loved.
We're looking for our Jalen Brunson. We just don't have it yet.
You were going there. You were close.
I didn't do it.
Yeah,
anyway,
but you were close. I know you were. I know you so well. You were there, right there. You were about to say a name.
I'm looking for broadening out as well in terms of.
I'll just ask the question: why do people love Messi so much more than Ronaldo? You were so close to saying his name.
Yeah, because Ronaldo is. Messi seems like a team player. He seems like he is someone who embraces a dynamic, and Ronaldo does not have that vibe.
These layers to Bramo, there's always extra depth. You just got to sort of
I love it. Agreed.
Up next, Nadia Lovell of UBS, Subadra Rajappa of SocGen, Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. Payrolls in the next hour.
Yeah.
This upcoming labor market data, we think we can start to see this softness.
The labor market isn't booming. I mean, it's okay.
The labor market is very, very tight.
Employment is a lagging economic indicator.
The data going forward, and most importantly, its implications for the economic outlook is what will drive Fed response.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores. The price action looks like this, just about unchanged on the S&P 500 following muted losses in yesterday's session. We're down on the Nasdaq by 0.2%. In the bond market, setting up as follows. 2s, 10s and 30s. Yields unchanged to the front end, 417 on 10s, up just a basis point, 449. 30 minutes away from payrolls data. The estimate in our survey, 113. The previous number, 172.
I'm not going to sugarcoat it. People are not that excited about this labor market report. There have been the most important labor reports ever. This is not one of them. It's been de-emphasized in part because of volatility in the numbers going into it, in part because we have seen such a range of interpretations of what numbers mean, and in part because Kevin Warsh himself, amid the bad dad jokes and other iterations of the family fight, are coming into really an inflation focus rather than a labor market focus. So how high is the bar for this to matter? Ultimately, it falls to the unemployment rate and it falls to the wage growth growth, because ultimately the headline number, yes, it will be interesting, but put it in the dartboard and get your darts out, and that's the interpretation.
Right, because the Fed is focused on inflation. You had Kevin Warsh yesterday once again reiterating he doesn't really love the labor market report because of the lag and the fact that then it gets revised some 18 months later. When you look at the scope, the range of potentially numbers we could see, 25K, some people, to 200,000. So does anyone really understand what is going on in terms of the labor market? And it's at a weird time, because when you look at the bullish calls, they're saying it's all because of leisure, hospitality, it's going to the World Cup. Nela Richardson says, well, that's yesterday's news.
So enjoy the World Cup and happy 4th?
Yes.
So I just sort of like,
Go to the beach, like Lisa said.
I'll just make an exit now and skip the 8 o'clock hour. Is that what you'd like me to do?
No, you stay.
No, we should
Please,
stay.
you stay. We'll leave.
Okay, we should stay.
Exactly.
You're going early.
Yeah.
Long weekend.
Exactly. Cheers.
Okay, all right.
Phone me when the numbers come out.
113's the estimate. I'll be around at 8:30. These two might not be. Coming up, Nadia Lovell of UBS with tech stocks whipsawed by a potential Meta pivot. Subadra Rajappa of SocGen expecting a strong 150K in a payrolls report. Stephanie Roth of Wolfe Research on how the data could boost odds of a rate hike. We'll begin this hour with chip stocks falling as techs post a rocky start to the third quarter. Nadia Lovell of UBS writing, this is still a market to stay invested in. Earnings are resilient, AI capex remains powerful, the economy is holding up, and Fed rate hikes are unlikely. The key shift for the second half is breadth. Nadia joins us now for more. Nadia, good morning, good to see you.
Good morning.
What does that shift at Meta, if we do indeed get one, represent to you and the team?
You know, for us, it's sort of a mixed message, but we think overall it's still constructive for the entire AI trade. And when you think about it, it could mean a couple of things. It could mean that what they've built and what they've contracted supersedes what they need internally, right? And so that does call into question whether the market is right. And some market participants thinking that maybe the hyperscalers have overbuilt and the monetization hasn't caught up to that. But at the same time, it also shows that away from monetization, the fact that they're potentially offloading this excess capacity and a way to monetize that, and that could alleviate some of the pressure for the capital intensity as well as margins as we think about over the longer term. So net, we don't think that it's a negative. When you look at the last earnings season, the first quarter earnings season, you saw that a lot of the hyperscalers grew cloud revenue over 40% and indicated that capacity was still constrained. And so we do think that in the near term, the demand is still there. You're seeing adoption rates increase. You see even from the U.S. Census latest data suggests that U.S. enterprises adoption is 21%. It's expected to get to 24%. And so we do think that the demand story is still there. But it does put a little bit of fly in the ointment.
Well, let's get to the signal in the price.
Yeah.
So bullish for Meta, it rallied. Bearish for neo-cloud companies, they sold off aggressively. The question we're asking is, what does it mean for capex going forward from here? And ultimately, the big trade. What does it mean for the chip players? How are you thinking about that?
Yes, and I think that's an important question. But the way we would think about it is that, again, the demand is still there. Like, yes, maybe longer term, it does call into a question to you, is CapEx going to slow? But at least for this year and into next year, we think that the CapEx numbers are baked at this moment. Maybe there isn't as much upside to them over the next 24 months. But longer term, we do think that what we're seeing within the chip space is that from a memory standpoint, it's structurally still constrained. Reality is, like, you know, we're moving from chat box to AI agent, and if adoption is increasing, that means that there's going to be a structural demand for chips. We're seeing what Apple is doing, clearly, you know. But that said, you know, I mean, last week we did take a little bit off of the table around semis and memory after the very strong rally in the second quarter in our transformation, innovation, opportunities AI portfolio, right? And redeploy that in some similar defensive areas, particularly in data centers as well, and some of the hardware companies to help manage that volatility that is likely to happen in the near term. You know, there is going to be a question is there an air pocket? And we have to acknowledge that near term, there could be some consolidation and volatility around the chip names.
This is important. How much are we thinking too much? Because how much is this we just saw the best quarter ever when it comes to some of these semiconductors. And now people are saying, all right, that's pretty good, but you can't get these gains forever. So let's just sell out of this and try to figure out where we should shift the money ball going forward. Is that really how we should interpret the narrative shift that we're sort of perceiving in markets?
I think near term there's some tactical trades, but longer term, like, you want to be really engaged within the AI trade, particularly the memory stock and position. So we're seeing some of this weakness. Like, while we might have taken a little bit off the table last week after a strong rally, this weakness that we're seeing we could potentially re-engage. That's interesting, right? Because when we look at the upcoming second quarter earnings season, we do expect that the fact that you're going to see cloud revenues continue to grow and accelerate from the first quarter and even into the third quarter. So I think at some point you have to sort of take these weakness, this pullback, as an opportunity for a structural long position in semiconductors, particularly around the memories.
What's fascinating is that you've seen a broadening out in overall performance as you've seen people take chips off the table, no pun intended. I'm not telling the bad dad jokes yet. Maybe we can, time is young. That said, going forward, how much do you need to see a very solid labor market to continue with this broadening out trend? I mean, it's sort of, damned if you do, damned if you don't. You get a strong labor market, people worry about inflation and rate hikes, and all of a sudden that could be a problem for the broadening out trade. On the flip side, you don't see an increase in jobs, and that's bad for the broadening out trade because with our economy. So how are you interpreting this?
You don't need a strong labor market for the broadening out trade. You just need a balanced labor market and a labor market that isn't signaling that there's a significant slowdown and, potentially that's going to cramp consumer spending. And we've already seen that this year. The fact that reality is we have seen the broadening out on the margin, right? It's not just the Max 7 anymore by any means. And you're also seeing, like even recently, people leaning into financials, into industrials, into healthcare. You're seeing a pickup in M&A. So there are other factors that are driving the broadening out trend, not just contingent on the labor. And reality is, regardless of how the American consumer feels, we show up and spend, right? And we're seeing that in the numbers, right?
Amen.
And the fact that you have easing energy prices. Remember, the high-end consumer has remained strong and resilient. The middle income is stable. The lower income has been under stress. But the fact that you're now seeing lower energy prices, and I hear my president is going to bring it down even more, right? The U.S. president is going to bring it down even more. That could be on the margin a positive for the lower-end consumers. And that's why you're seeing, even in consumer discretionary, some of the names in the last week that are rallying, whether it's housing, whether it's airlines, and so forth. So I don't think that you just need a labor market that is not collapsing. And you heard Nela said that already. It's not collapsing. Can moderate on the margin, and the American consumer will continue to spend and push the broadening out trade forward.
This is the hype I needed going into 4th of July weekend. Thank you so much. So when it comes to...
Are you going to spend? Is that what you're saying? Okay.
Yes, I am definitely going to spend. But I think so is America, right? It's one of the biggest driving weekends celebrating this year, especially the 250 exactly. But when you say that it's broadening out, is that a proper broadening out because of the economy, or is that because people are hedging against all these massive trades they have on AI, and it's becoming a little bit more nerve-wracking?
I think it's a combination. It's both. The fact is, you are seeing. Look, ISM. Look at the ISM numbers. You're seeing improvements there, right? You're seeing in parts of industrials, right? Some of those short-cycle industrials are also picking up. Backlogs are also improving. So I think it's a combination of both. That you do want to, and this is something that we've been talking about since the start of the year, is the fact is like you want to manage concentrated positions, right? And so that's helping. But I think overall, the fact that you have an economy that's resilient and that's showing up in the data, and now you have inflation that is easing, that is what's going to drive the broadening out. And in reality, our view is, despite what the market is pricing in, we don't think that the Fed is going to start a renewed tightening cycle. Yes, rates can remain higher for longer, but ultimately we think that the data will support a renewal of a cutting cycle in the first half of next year.
Speaking of easing inflation, these headline crossing, just as we're having this conversation, Saudi Arabia, oil exports approaching pre-war levels, exporting 6.3 million barrels per day in the 6 days through Wednesday. Some encouraging signs are building.
Some encouraging signs, meaning with these kind of numbers coming out of Saudi Arabia, it means that when it comes to the Strait of Hormuz, things are slowly getting back to normal, or at least maybe now they're very close to being back to normal. Obviously, there's some skirmishes we potentially could see, but the MOU at the moment, in terms of reopening the Strait, that one objective does seem to be working.
We have almost totally wiped out the wartime rally. Brent crude close to breaking into the 60s. Brent this morning at 70, WTI at 67. Nadia, thank you. Happy 4th. Very patriotic. Appreciate it.
To America, 250.
There we go.
Let the fireworks go off.
Buy stocks. The message from Nadia. Nadia Lovell of UBS. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. OpenAI is discussing giving the U.S. government a 5% stake in the company. The Financial Times reporting CEO Sam Altman is in active talks with the government. His proposal includes the possibility of Washington also taking a stake in other U.S. AI developers. Alibaba and its U.S. digital payment processor agreeing to pay $600 million to resolve a federal investigation into the sale of illegal pharmaceuticals and controlled substances. The investigation found that overseas customers used Alibaba platforms to buy the products. In sports, Team USA back in the round of 16 at the World Cup for the first time in 24 years. The Americans beating Bosnia and Herzegovina 2-0. They'll be without their top scorer, Folarin Balogun, though, in their next match against Belgium after he was given a red card. And that is your Bloomberg brief. John.
Team USA winning, Nadia, Lovell, Bullish.
It's awesome.
All lining up nicely into the weekend, isn't it?
It's going to be a great week.
Yeah.
Yeah, 250. But we got to get rid of the red card.
I don't think they can do that.
I know. It's a
Unfortunately.
problem. Maybe a truth's coming about that.
But I do think we need to have a look at VAR. Going forward from here, I said this earlier and I'll repeat it. I don't think you can watch those replays in slow motion and understand the intent of a football player. You have to watch it in real time. You have to gauge it on that. Otherwise, you're coming up with a completely different picture of what happened.
Yeah, you know, there'll be a lot of discussions. I have bad dad jokes in my head. You get a red card and a white card and a blue card because it's the 4th of July.
That doesn't work like that in soccer.
Okay. Thanks, Bramo. When are you leaving?
There's no white or blue card.
When are you leaving? Kill the mic. Get away for the weekend. Up next, the morning call. Subadra Rajappa of SocGen also joining us, expecting robust jobs growth. The payrolls report is just 18 minutes away.
No one wants to hear about AI generically. They want to hear what's your use case? What have you done with it? What have you been successful with it? They want case studies. That's a very different conversation than this time last year where everything was kind of free. This is kind of where the rubber hits the road. Are we getting enough and do we see a slowdown in AI spending?
That was Peter Tchir of Academy Securities weighing in on the tech trade. Equity futures this morning just about positive by 1/10% on the S&P, on the Nasdaq up by 0.16. Breaking news, Bramo's still here. Hasn't left yet.
And she has her finger up. She has
Hold on a
something to
second.
say.
I actually got feedback from a terminal user saying that white cards are in football and blue cards are in football. So you put that together, like that isn't necessarily crazy. And I just want to put
which
it out.
sport?
Football.
American football.
I can't tell. No, actually, no.
Are they winding you up?
No. The referees will have the power to send players off for 10 minutes for dissent or cynical fouls. And that would be a blue card, potentially.
What game are they talking about?
They're talking about European football.
That's not a thing. Are they winding? Is that going to be a thing?
It might be. It's proposed. Sky Sports.
That's a proposal. Okay. Is someone winding you up?
Well, if they haven't, no one uses it.
So I'm going to send it to you.
They sourced it.
They sourced it.
It's a potential
BBC
proposal.
and Sky Sports.
A potential proposal.
Yeah.
Okay. You staying with us? Maybe.
If you'll have me.
Of course. Of course. You elected to leave. To start a long weekend, you said payrolls is pointless.
All right, let's go. I didn't say it's pointless. I said it's just a high bar for it to be really important.
All right. Futures are positive by 1/10%. Lisa making things up. In the bond market, yields up by a basis point. Twos at 418, 10s at 450. We're up by 2 basis points to the long end. The payrolls report just around the corner. Let's get you some morning movers this morning, some morning calls. Your first call from HSBC, upgrading Adobe to buy, saying the stock's reward now outweighs the risks. Your second call from Wells Fargo, cutting its price tag on Alphabet to 416, citing plenty of reasons for optimism against the backdrop of escalating investment. And your third and final call from Bank of America, reiterating Meta with a buy. 835 price target, seeing potential for multiple expansion as model improvements progress. That stock is down this morning, but it was firing on all cylinders in yesterday's session.
Yeah, it was up more than 8% at one point because people see this as actually a positive revenue stream. A really interesting upgrade or buy, at least, on Meta. And a question here about their abandonment of their AI models as being a positive because they can make more money elsewhere.
Can you send me that story so I can read it?
Okay, yeah.
Okay, thanks.
I was trying to pay attention.
I am seeing it used in Portugal's domestic football competition. So I'm not sure it's widely used, but maybe just for certain leagues.
I wasn't aware of that.
Making up things and suddenly, reality is better than fiction.
Manifesting, right? Yeah.
I'm manifesting my reality.
Payrolls just around the corner. Subadra Rajappa of SocGen expecting an above consensus 150, writing a strong print and a lower unemployment rate is what we might need to reinforce hikes for the coming year. Subadra joins us now for more. Subadra, good morning. Good to see you.
Good to see you too.
What are you expecting in 12 minutes' time? Let's start there. What are you looking for?
The change in non-farm payrolls at 150, so it's a little bit above consensus. unemployment rate at 4.3%. Overall, I think fundamentals for the job market is quite strong. We've seen that in last month's print and the months before that. 3-month moving average is over 180,000 jobs. So the labor market is in a very, very strong place. And if anything, we're seeing a significant rebound in the last few months.
Is the July meeting live? Family fights, we're told, but does that mean this is a live meeting?
I think there's going to be a very active discussion. I just don't think that they're going to necessarily have a policy action. They probably keep policy on hold and wait for data. I think it's a little too soon. We might react to the labor market data that we get today, but it ultimately depends on what happens on inflation. If you look at the statement, they did not really focus on the labor market, they focused on inflation. So we'd be looking to see what we get in CPI and PCE for the month of June to make a decision on what happens in July.
Do you think that the market has repriced inflation expectations because of Fed rhetoric or in spite of Fed rhetoric?
So I think inflation expectations are mostly a reflection of what has happened in the oil market. We've seen a significant decline in oil prices in a very short amount of time, and inflation expectations are really just reflecting that reality. To be honest with you, I feel like inflation expectations have gotten a little bit ahead of itself in pricing in too much of a normalization of expectations over the longer run. But I think, over the near to medium term, you are going to see core PCE start to head higher. And you're not going to really see that in the expectations data.
Right now, is the labor market a lagging indicator that has less import? I mean, I know everyone's excited for this labor market report, and I am actually really looking forward to this. I want to see the components coming in. I want to understand what the average hourly earnings are. I want to see all of these components. But it isn't the blockbuster kind of labor market report that we've seen in the past. When's it going to matter again?
It could be, and it has mattered for the last few months. It's almost the counterfactual that matters. If you continue to get good data, it makes it somewhat easier for the Fed to think about just the inflation mandate. If you start to see an environment where the labor market starts to weaken and you start seeing inflation start to go up, that's when you need to be concerned. Overall, I mean, the trajectory for growth has been relatively strong. Maybe we see a little bit of a slowdown in the second half. And labor market's been, rebounding quite meaningfully in the last few months. And we think that trend is probably here to stay.
Do you get a sense, though, of what Kevin Warsh's reaction function would be to a weak labor market report?
I think it's, again, too soon to react to one data print. You look at the 3-month and 6-month moving averages, it's actually quite strong. You look at the regional Fed surveys, the employment components are showing strength. Again, ISM manufacturing, the employment component is showing strength. So the labor market is definitely very, very, it's kind of a stabilizing force, if you will, for the Fed, because then they can focus on their other part of the dual mandate, which is inflation, which is rising quite meaningfully.
If they're focused so much on inflation, then potentially that does mean a hike this year.
Potentially. I mean, I think the market's pricing in for a hike by the end of the year and perhaps even 2 by the middle of next year. For the Fed to move towards that direction, start thinking about hikes, you're going to need to see a stable labor market. If you start seeing inflation continue to pick up as well, you're going to see the Fed focus much more on the inflation side of the mandate. So a hike is not out of the table. Our call is for the Fed to keep policy on hold for the remainder of the year and perhaps the remainder of next year as well, as inflation remains hot and sticky. But that could change if we start seeing a trajectory towards core inflation continuing to drift higher.
And do you think we've seen a peak in bond yields?
I do think that we've seen the highs for the year.
Huh.
I think that you're going to see perhaps a gradual normalization of interest rates during the remainder of the year and next year as well. But a lot depends on what's happening in global bond yields. You've seen a synchronized decline in global bond yields since the beginning of May to now. Now you're starting to see JGB yields drift higher. That's kind of dragging the global bond yield complex higher. But fundamentally in the US, you're going to look towards the trajectory for growth. You're starting to see a normalization of growth. Yes, inflation is high and sticky, But I think over the remainder of the year, between now and the middle of next year, you're going to see a gradual drift lower in yields.
Where does that leave the shape of the curve? Because the curve has been flattening. What are you anticipating will happen?
I think the yield curve remains flat. I mean, that's been one of our calls for this year, is that the yield curve will flatten and remain flat. I think that's how things are going to play out. I mean, for the yield curve to steepen, you're going to need to see some change in the dynamics. It could be debt and deficits, it could be global bond yields, but we don't really see any catalyst over the near term that's going to cause the yield curve to steepen.
When was the last time you were this bullish on bonds? You've been actually really negative on bonds. Is it because of the Fed pivot or because of sort of the reaction function that we don't know about but seeming more hawkish?
I'm not necessarily bullish on bonds. I think that bonds are going to be somewhat range bound, and yields are going to be somewhat range bound for the remainder of the year and into next year. But the gradual trajectory is going to be towards lower yields over time as we sort of look at the trajectory for growth and the potential for an environment where things start to normalize a little bit more after the war.
Subadra, it's good to see you. Always great to catch up. Thank you. Subadra Rajappa there of SocGen. Several headlines in that conversation coming through from Mary Daly of the San Francisco Fed president, sitting on the fence like a real economist, on the one hand this, on the one hand that, but ultimately there is the potential to need to fight more persistent inflation at this Federal Reserve.
Yes, he said the resilient consumer is a good sign for the economy. She was talking about how U.S. investment is continuing and she doesn't see any signs of it slowing down, but then also saying she still sees Fed policy in a slightly restrictive position. So for people who are saying our star is higher, that perhaps we are seeing a more neutral rate where the Fed could arguably remain on hold, seeming to contrast that. Ultimately, if you're looking for a signal in this rhetoric, you're not going to find it. Nonetheless, what you are seeing is a Federal Reserve clearly watching the data, watching the football.
And watching AI investment. Strong U.S. investment growth not likely to come down. We heard this yesterday from Kevin Warsh, who said this is a problem he likes to have. This is something good because he also, through a little bit of shade, was like, this is only happening in America. This is a U.S. problem because of that investment.
Do you want to hang out for another 30 minutes? Do you want to stick around?
Yeah, I'm totally here, although I think a couple people have messaged saying that it's time to send me on vacation. So,
They might be at the beach already. Many people are.
Yeah, other people might have gotten the hook from me.
It's almost beach o'clock. It's like 8:31. Gone.
Let's see. It might not be.
Right?
Maybe they'll just take everything up.
The Payrolls report just around the corner from New York City. You're watching Bloomberg TV. The opening bell 60 minutes away. The job number seconds away. Equity futures into it. The scores look like this. We're positive by 0.1% on the S&P 500. On the Nasdaq 100, up by 0.25%. On the Russell, up 1/3%. In the bond market, 2s, 10s and 30s. Yields shaping up as follows. Your 10-year just short of 450 and up 2 basis points. With your jobs report, Mike McKee has more. Good morning, Mike.
Good morning, John. Numbers are just starting to come out, and it is a disappointment for this July 4th holiday weekend. 57,000 jobs is the total, and we saw last month's 172,000 revised down to 129,000, so a net revision of -74 over the 2 months. Change in private payrolls, 49,000. The forecast was for 107, and that was 120,000 the month before, and it's been revised down to 97,000. Manufacturing payrolls up a week, 3,000, but that's what was forecast. The average hourly earnings come in at 0.3, which bumps up the average hourly earnings on a year-over-year basis to 3.5%, still below the level of inflation, but it is a move in the right direction, I guess you could say. Average weekly hours, 34.3, same as in May and same as forecast. The unemployment rate, though, drops to 4.2% from 4.3%. That's about what the Fed thinks the natural rate of unemployment is. So overall, they're going to look at that instead of the job creation numbers and say that the labor market looks pretty steady. Participation rate, 61.5, drops from 61.8. We also got one other number today that nobody's going to care about, and that is the initial jobless claims. They come in at 215,000, down 1,000 from last month's revised 216,000. So let me dig into where the jobs were created or not, and we'll see what's happening in the market.
Mike, you take a second look. Thank you, buddy. Appreciate it. Downside surprise on payrolls, 57K. The estimate 113. The previous month, downward revision, 129 from 172. In the market, you can predict what's going to happen here. Front end of the yield curve, 2-year yields come in, we drop, yields down across the curve. 2s at the moment down by 5 basis points to about 413. 10s down by a single basis point at 446. We'll get to some of that price action in just a moment. That unlocks this move in the equity market. Equity futures pushing higher by 1/3 of 1% and just off session highs on the S&P. On the Nasdaq 100, a turnaround there, up by 0.5. On the Russell, small caps up by 0.7, outperforming given the move we're seeing in the bond market. But Lisa, to take a step back, you can tell two different stories here based on the headline payrolls number, and then again with a different story based on the unemployment rate.
If you look at the headline numbers, it's a disappointment. It's a deceleration in job growth. Suddenly, the 3-month average looks less robust than it did in the May payrolls report. If you take a look at the unemployment rate, you're going to say we're bumping up against the ability to create more than, say, 20,000 jobs without creating an even tighter labor market, that essentially any job creation in this market is enough to break even and then some, which is a real question we've been asking. What does the headline number actually mean? The fact that we're looking at 4.2% unemployment rate, that is the lowest level going back to June of 2025. So really a mixed report here when it comes to what the signal is going forward.
Well, when you look at the labor force participation rate, that's down 61.5% from 61.8%. So people seem to be leaving the labor market, which maybe explains why that rate has dropped. And that's not a great story either to tell.
And Mike McKee, you got a second look. What'd you see?
Well, right now I'm looking at the labor force fell by 720,000, which accounts for the drop in the participation rate. That's a big number. We had an increase of 83,000 in the month of May. Employment fell by 507,000 in the household survey, while unemployment fell by 213,000. So we have a slight decline, largely because of the size of the labor force falling in the unemployment rate. And it looks like, on first glance, most of the jobs that were created were in the healthcare and social services categories. There is an increase in business services, which is the sort of temporary help, and that is usually a sign of a kind of a rebound. But here's the interesting thing. We lost like 61,000 jobs in leisure and hospitality. First, you got to figure in the seasonal effects, but there was an expectation we might see a big jump because of the World Cup, but it doesn't seem to have come through in this month.
Mike McKee, thank you, buddy. We'll come back to you in a few minutes' time. As anticipated, with a number like that, you don't price out a rate hike per se, you push it back. And that's what we're doing right now with rate pricing, pushing it back to December. Previously, we were baking in something around October. You look at these numbers, expecting a family fight at the end of this month at the Federal Reserve. Does that family fight get a little bit less, let's say, testy at the end of this month with a number like that?
This does not suggest that there's urgency to make a move in any which way, because ultimately this doesn't necessarily speak to incredible weakness, but it also doesn't speak to some sort of incredible expansion. It kind of goes to what Nela Richardson was saying, which is you saw the May print really highlight the World Cup jobs created. Maybe this is the June report taking them back after the infrastructure was laid for the World Cup games. You look at this, it doesn't give you really any clear signal. So you're right. It doesn't necessarily increase the urgency and takes July, pushes it further off the table.
If you're just tuning in, welcome to the programme. So we got the jobs number just moments ago, came in at 57K. The estimate in our survey was 113. The previous number revised down. The unemployment rate, for a bunch of reasons, we'll spend some time on that, dropped back from 4.3% to 4.2. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
What would you put weight on this morning looking at this report?
Yeah, I mean, I think the main message from the report is payrolls have been overstated to some extent in the recent prints. We're sitting in a labor market that's largely in balance. The unemployment rate, yes, it's ticked down, but realistically, you know, the household and the establishment surveys have been telling you slightly different signals. It kind of makes sense. It tells you the labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking, and that buys them time. The longer that they have to buy time, by that point, inflation will be slowing down a bit, and that will probably allow them to stay on hold.
The chairman used a word to describe this particular jobs market. He said it was steady. Would you call it steady, this labour market?
I think that's exactly right. And I mean, there's been a lot of volatility in the actual data itself. It seemed odd, the extent of which payrolls had been running significantly above anyone's estimates of break-even for many months. and you weren't really seeing wages pick up. You weren't seeing it confirmed, that extent of the tightness confirmed in other surveys. So it kind of suggests that payrolls had been overstated to some extent. If you look at the birth-death adjustment for this month, it was a little bit lower than it was last year at this time, so perhaps that is just adding to some of the volatility, made it a little bit lower than would otherwise be the case.
I remember speaking with San Francisco Fed President Mary Daly about a year ago, and she said that typically at turning points in the economy, you can get this churn, this lack of clarity in the labor market. It feels like that churn has continued for a really long time, even though usually it does tend to tip one way or another. Are we looking at it wrong? Is there something else that's happening here, some evolution, some sort of shift in terms of the emphasis going forward that we can glean from these successive labor market reports?
I think what we've learned is certainly there's a lot of volatility, a lot of surprises. Of course, this time the surprise has been on the negative side, and the prior months it's been on the positive side. Realistically, the result's somewhere in the middle, where the labor market seems to be in pretty good balance. It's running probably close to break even, whatever your estimate may be of that. Our estimate is around 75,000. So our estimate is that you're probably just in a pretty good balance. The economy's in a decent spot. And the inflationary pressures don't seem to be generated from the labor market. It seems to be generated elsewhere, in which case that should roll off. We expect about 100 basis points coming off core PCE by the end of 2027. But it'll take a little bit of time.
The market doesn't do well with remaining on hold. Usually people are saying, okay, which direction are you moving in? Which is the reason why there's this obsession of what's the next move for the Federal Reserve, rates up or rates down, partly because people want momentum. But are we really looking at is that we are at neutral and that essentially this rate is allowing the economy to kind of muddle through whatever technological transformation is underway?
I think that's probably right. And by the way, the technological transformation doesn't really depend on the level of interest rates today, because that's going to happen regardless of whether rates are plus or minus 25 basis points from here. So realistically, we're in an environment where interest rates are largely neutral. Of course, there are parts of the economy that it feels restrictive, as certainly Warsh had talked about in terms of housing. But generally speaking, it seems to be in a pretty good place. Consumers are spending fairly well. It's been a decent, call it 2% trend in spending. It's an economy that is in pretty decent balance, and I think that will continue through much of the summer and the rest of the year.
What about the participation rate, falling by 0.3%?
My guess is a lot of it is noise to some extent. The household survey is notoriously volatile. By falling by 0.3 is a big move. 700,000 people exit. We tend to get a lot of volatility in that report, and my expectation is in the next print you will see it rebound.
What about revisions? Make you nervous or no?
No, it makes me feel better, because it didn't make sense of how strong the labor market is relative to anybody's expectation of break even. So, seeing some revision to the prior months that seemed stronger than what made sense, I think, it makes me feel better about sort of the data and the trajectory, and it makes a little bit more sense relative to where other indicators are.
I think some people will look at this data and agree with you. The Fed's got some time to figure this out. 3-month average is 111. It's not bad, is it? 3-month average of 111 on payrolls. Unemployment's close to 4%. Inflation's above target and has been for 5 years now, which is why they need to debate whether this rate is the right interest rate for this economy to help inflation get back down to target, whether things are out of their control or whether they need to raise interest rates.
And that's why some people are still calling for a July rate hike, or the potential for one, simply because if you are getting impatient with the level of inflation for so long, well, then what's the argument not to take action if this truly is a sort of watershed moment in terms of hitting the highest level going back some 5 years with the latest inflation read? That said, it seems like a good summer to take a step back, sit on a task force.
You're still trying to leave?
No, I'm not trying to leave. I'm trying to lobby for a task force. I want to really understand,
Don't worry, there's no one left. Everyone's gone.
Well, I wish you a great time. I'm just going to stop talking now.
You're not alone. So, on the way to the Hamptons.
Well, this didn't stop anyone's vacation plans. Let's just put it that way. This doesn't change the material.
Totally agree with that. Mike McKee's ready to go. I don't know if you've seen Mike. White pants are on.
Yeah, he's got his bag over there.
Mike's ready to go.
Hey,
I
Mike.
know. Mike's back with us for more. Mike, you've had a third look. What do you see?
Well, right now, what we're kind of looking at is the unemployment situation. It goes down because the labor force fell off significantly, which raises the question of, are we not hiring as many people because companies don't want to hire, or because they can't find people? That's going to be one of the questions that the Fed is asking as they look through this data and try to figure out what's going on. But the fact that we're at 4.2%, that's going to be the number that they focus on as opposed to job creation, because 4.2% of the people who want jobs are unable to get jobs, and that's a very low number. So for them, that's good. Now the question is, if it is a shortage of workers, is that's what going to push up wages and create an inflation problem, or is this just a temporary kind of one-off thing? So those are the main things to look at. The thing that really is surprising, though, is when you look at these numbers, what happened with leisure and hospitality. I assume a lot of it is basically because of seasonal adjustment factors, but what we saw was 61,000 for the whole category, 54,000 in food services and drinking places and accommodation and food services. So the kind of jobs that you would expect people to be getting in the month of June, and then throw in the World Cup on top of that, they lost a significant amount. We haven't seen a loss like that in quite some time.
Beat the traffic, Mike. Thank you, buddy. Appreciate it. Mike McKee there, breaking down the jobs report. Stephanie, final word. To Mike's point, he raises a really important question. Do you look at that 57K and see that as the outcome of demand or lack of supply? Lack of workers to meet maybe demand that is out there?
I think I would like zoom out and look at the 111,000 or so on the 3-month average, and I would say it's an environment where labor and supply are in good balance. So I wouldn't extrapolate on the most recent reading, because if you look at the prior months, it was higher.
Sure.
The overall trend is something where demand and supply seem to be like pretty much in line. Wages were a little stronger this month. Last month they were a little bit softer. Generally speaking, it's a labor market that is in balance when it comes to supply and demand, and that's one reason why we're not seeing significant inflation generating from the labor market.
Operation Get to the Beaches, go, right? We can all leave, right?
Yeah, sure.
Permission to go? Cool. Stephanie, thank you. Stephanie Roth there of Wolfe Research. We're not going anywhere. We've got 17 minutes left. Looking at 57K on the payrolls report, the estimate at 113, trying to keep hold of Bramo until 9 a.m. Eastern time. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. So recapping the data we just got, non-farm payrolls coming in at 57,000 for the month of June. That's well below the estimates, which called in the consensus for 113,000 jobs created. The unemployment rate falling slightly to 4.2%. Blue Owl imposing redemption caps. The limits coming after investors asked to pull more than 38% or $1.1 billion from one of its tech funds in the second quarter. It's slightly lower than requests in the prior quarter, but the highest among major funds. In sports, the NBA champion New York Knicks are losing their longest tenured player. Center Mitchell Robinson signing a 3-year deal with the Boston Celtics. Celtics also making waves, trading their star guard, Jaylen Brown, to the 76ers for Paul George and draft picks. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for this morning. Up next, we'll catch up with BlackRock's Jeff Rosenberg as markets digest the payrolls print. Plus, Yahira's back with us with some morning movers, shares of CoreWeave and Nebius attempting to recover from yesterday's sell-off.
We're sitting in a labor market that's largely in balance. It kind of makes sense. It tells you the labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking, and that buys them time. The longer that they have to buy time, by that point, inflation will be slowing down a bit.
Stephanie Roth of Wolfe Research. Stephanie's right, just the way you framed this. You're not closing the door on a rate hike with this jobs report, but you are removing some of the urgency on the margin with the downside surprise we just got on a headline number. Unlocking this move in equities higher by 1/3 on the S&P, reversing some of the losses from earlier on this morning on the Nasdaq, up by 0.5, outperformance on the Russell, up by 0.6 after a massive Q2 for the Russell, up by more than 20%, all-time highs on the Russell coming into the second half of the year. In the bond market, this move at the front end of the curve, down by 5 or 6 basis points, just dancing around between 4.1 and 4.2%-ish. That's kind of the range over the past few weeks. The 2-year at 4.1184 so far this morning. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Even before the jobs report, we started to see these neo-cloud gains rebounding in the pre-market after a brutal session yesterday that saw CoreWeave fall 14%, though it is now up 2% in the pre-market. And blame it on Meta and are reporting that it wants to sell access to its AI computing power. The concern was that if Meta opens up its AI infrastructure to customers, That could be a competition to these companies. Plus, it could ease the shortage of AI computing capacity that has fueled their growth. Turning to a call by Gil Luria over at D.A. Davidson. He is upgrading Palantir to a buy, so shares are up nearly 2.7% in the pre-market. He's saying that this name is gaining a competitive advantage as AI companies like Anthropic continue to see friction with the U.S. government. And we end on Bending Spoons. This is the latest company to go public, though it is giving up some gains after a blockbuster debut yesterday that saw the stock soar 40% on the NASDAQ. Shares are now down 6.4%, but investors yesterday seemed to embrace its business, which involves buying software companies like AOL and trying to turn them into more profitable businesses. John?
Yahara, thank you. Appreciate the update, Yahara. There was some single names. This is the update on the payrolls report. 57K. The number for the month of June, the estimate was 113, a downward revision to the previous month as well. So a downside surprise on headline. The unemployment rate dropping back to 4.2%. From 4.3%, and wages coming in line with expectations, 0.3% month over month, 3.5% year over year. Joining us now to explore some of the data and what it means for this Federal Reserve, Jeff Rosenberg of BlackRock. Jeffrey, welcome back to the programme, buddy. Always good to do this with you. What's the initial response to this, and where do you think it leaves the conversation month-end around the labour market at this Federal Reserve?
Yeah, my initial response is I think this is a great report for Kevin Warsh. I think it's a good report for the bond market. I think it takes any pressure that there might have been within the committee around the peak of inflation and policy rates being too accommodative as a result, kind of pushes that story back. It doesn't eliminate it, but it gives him room, and I think Stephanie Roth had the same point, it gives him room for the decline in inflation that we see in the data that's coming through, particularly getting a boost from the oil price declines as well, but also finally seeing the declines in terms of the tariff pass-through and that story showing up in the data and validating, I think, Warsh's view that we can be patient here. So this helps him to be patient. And for the bond market, Jonathan, you've already had this turn in momentum from fear of the Fed hikes to the inflation is coming down. Warsh is going to be more friendly. The momentum is towards lower rates. And I think this helps to continue that momentum.
Do you think that the market is overplaying the idea that the Fed is going to hike at all, and that, frankly, they can just remain on hold long enough for disinflation to come in enough?
I think we're seeing the market push back on the pricing of the hikes. I think that the challenge is the market is sort of dealing with the old reaction function. I felt like there was an overreaction to the dots in the FOMC statement. I think Warsh was very clear. He told us again, or hinted again at Sintra, the dots are going to go away. He used the language of, yeah, people wrote down their dots with a big pencil eraser on them, but the market is still, using the old reaction function. I think it overreacted to the dots and the surprise from there, and I think we still have to price some of that out. And I think today's data, and more importantly, the inflation data to come, is going to help to push that expectation even further out of the market.
Jeff, what's more important to you, the task forces or the earnings that we get from some of the hyperscalers in terms of the announcements of their CapEx?
Wow, that's a super interesting question. I think they operate on very different timelines. I think the hyperscaler earnings, the AI story, what you just led with in terms of yesterday's news, what we're seeing this morning in Asia, that's today. That is going to drive this market today. And those are the issues. I've talked about it before. The micro is the macro, AI in the macro data, AI in the markets. It is the dominant feature. I think what the task forces are about and what Warsh is about are some longer-term structural changes to the institution. I think it's highly consequential. I think it's very important. I think the really key objective here of removing the Fed as the prism through which we in the market view data and taking them out of that position that they've been in since the GFC, I think that's a much longer term objective. It'll take a lot longer for that to occur. And that operates in the medium to long term, whereas the AI data, the earnings, the headlines are going to be driving the markets, right now.
Hey, Jeff, $1 trillion question. How quiet's the office today? Be honest.
It is a full office of professionals working hard for our investors, Jonathan, just like I'm here in our studio. And so, it's going to be a quiet day in the markets, clearly, and in the bond markets in particular, ahead of the holiday. So we hope everybody can enjoy that. But we've got a lot of things to work on.
I believe you, Jeff. Good morning, Larry. Thank you, Jeff. Jeff Rosenberg of BlackRock. Thank you, buddy. Appreciate it. Operation Beaches go, right?
I think that a lot of people are excited to have a couple of days of a lack of volatility. Look, it's not like everyone's being lazy. It has been a whipsawing, difficult year.
What's on accusing anyone of laziness, Bram?
This is, an embrace of family, of relaxation, of celebration. I think that's
America's birthday, 250 years.
Right.
It's pretty incredible, actually.
Do you think we've got license to leave a little bit early?
Yes.
Like seconds early. Let's
like
do this.
Now.
All right. Yeah.
I'm leaving before 9 a.m.
Go to bars.
You can leave. Downside surprise on payrolls. Equity futures positive by about 1/3 of 1% on the S&P. Coming up on Monday, they are actually going away for a long weekend, a long weekend. I'll be solo on Monday with Alex Altman of Barclays, Mike Wilson of Morgan Stanley, Neil Dutter of Renmax, Sarah Hunt of Alpine Saxon Woods. To this great country we're all lucky to call home. Have a very happy 4th. To America, happy 250.